Hello guys, welcome back once again to the Financial Academy YouTube channel. So if you are seeing me for the first time, my name is Financial Academy. Are you getting my point? Yes, of course. My name is the Financial Academy. On this channel, I teach everything concerning the forex market, the stock market, and the cryptocurrency market. So if this thing is what you like, make sure to like this video, make sure to subscribe to my YouTube channel, and also comment down below if you have any question concerning any of my single video. Are you getting my point right now? Make sure you subscribe to my YouTube channel. Subscribe to my YouTube channel. Are you getting my point? Like this video and share it to your loved ones. Are you getting my point? So in today's video, I'll be teaching you from where I stop the full tutorial of what forex is to the end of what forex is. So this thing is gonna be a full long 10 hours course on forex trading. So I'm gonna be starting from episode 3. I have already created the episode 1 and episode 2. So go check it out on my YouTube page. Then from this video henceforth, I will teach the episode 3, episode 4, episode 5, and so on and so forth until I finish it. So it will be a very long, lengthy video, about 10 hours plus. So it is a 10 hours video course. So make sure to watch it from beginning to the end. Even if you can't finish it, save it, watch it the next day, because this video is gonna be a full video course on everything concerning the forex trading, concerning the financial market, especially trading in particular, forex. So this video is gonna be very lengthy. Make sure to watch this video from the beginning to the end if you want to understand everything concerning all about the forex, the history of forex, how to trade forex, and how to be a successful trader. This video is gonna give you everything you need for you to start. You don't need to go and buy the course. No, you don't need to go and buy course again. This video alone will help you and achieve those things. So it's gonna be a very lengthy course, 10 hours plus thereabout. Make sure to watch it from the beginning to the end. Like this video and stay glued. Let's now dive in straight into my video. I will start from where I stop, which is the episode 4 till I finish all of them. Let's head over to my YouTube video. Let's go. Thank you.
Hello guys, welcome back once again to my screen. Welcome back once again to my screen on this episode 3 of my full forex trading course. So you're welcome back. So let's continue from where we stop. So this is my episode 3 of my full forex trading course. Let's continue. Forex instrument, the building blocks of currency markets. So in this episode 3, I'll be talking about the forex instrument, which is the building blocks of the currency market. Let's continue. When you step into the world of forex trading, one of the first things you will encounter is the term forex instrument. They are the various financial assets or tools traders use to speculate on currency price, movement, and related markets. Understanding them is essential because your choice of instruments determines how you trade, your level of risk, and the strategies you will use. So in this video, we will break down the main forex instruments, what they are, how they work, and why they matters. Are you getting my point right now? So in today's video episode, in this third episode, we'll be talking about the forex instrument, because there are so many instruments that are being traded in the forex market. Are you getting my point? So if you are watching this video and you continue watching the video, I will break everything down on what is forex instrument and the types of forex instruments. Are you getting my point right now? So let's continue from where we stop. What are forex instruments? Forex instruments are the financial products available for trading in the foreign exchange market. They represent the different ways traders can participate in the currency price movement or related financial assets. Understand? So in simple terms, forex instruments are the tools that connect you to the global currencies. Understand? So each instrument offers a unique structure, risk level, and potential reward. While all involved in currency, in some ways they differ: ownership, leverage, regulation, and trading purpose. So main types of forex instrument. So there are different types of forex instrument, and as you are watching this video continuously, you will see different types of forex instruments, what they are and how they are being used in the global financial market. Are you getting my point right now? So let's continue from where we stop. So let's explore the most common instrument in the foreign exchange market. Are you getting my point right now? Number one is spot forex. So spot forex, also known as currency pairs. This is the most popular and straightforward types of forex trading. In the spot forex, currencies are bought and sold for immediate delivery, typically within 2 business days. You trade one currency against the another. Like example, Euro USD, GBP USD, or USD JPY, based on their current market price. So spot currency or currency pair are straightforward and most popular types of forex trading, whereby you trade on almost immediately, in the market, and you can trade between the 2 business days or 3 business days, depending on the type of trader you are. So, and this type of spot currency pair are the Euro USD, the GBP JPY, or the USD JPY, based on the current price, and other so many currency pairs. So they are the spot currency, they are the spot forex. Are you getting my point right now? So let me give you an example. If Euro USD is equals to 1.1000 and you believe the euro will rise, you buy or go long. If the price rises to 1.100, you make a profit from the difference. Why traders love it? So in this very section, I'm gonna be telling you why traders love to trade the spot forex or the currency market. Number one, high liquidity, meaning easy to buy and sell. Number two, low spread. Low spread in the sense that there are little to no spread. There is a very tight spread in the market. Number three is instant execution. The moment you place your buy or sell trade, immediately your broker activates your position immediately. Highest a few milliseconds, your trade has been already been activated. I got to my point. Then the other one is, which is the fourth one, is suitable for short-term and long-term traders. So this kind of types of forex is suitable for both long-term and for both short-term trader. Understand? If whether you're a day trader or you're a swing trader or you're a position trader, this type of forex is for you. Let's continue. Number two is currency futures. Currency futures. Futures contracts are standardized agreements to buy or sell a specific currency at a predetermined price and date in the future. So futures contracts are standardized agreements to buy or sell a specific currency at a predetermined price and date in the future. So unlike the spot market, futures are traded on regulated exchange. Are you getting my point now? Futures markets are not traded in normal brokerage brokers platform. No, they are being traded on regulated exchange. Are you getting my point right now? For example, such as Chicago Mercantile Exchange. Are you getting my point? So examples of futures exchange company are Chicago Mercantile Exchange. So let me give you example so that you will understand what and how the futures exchange or currency futures is being traded. If you agree to buy 100,000 Euro USD at 1.100, 90 days from now, if the euro appreciates by then, you profit even without ever physically owing the euros. Are you getting my point now? So in this example, is more of like if you want to buy 100,000 Euro USD at the price of 1.100 from 90 days from now, even if the euro appreciates by then, you profit even without ever physically owning the euros. Let me tell you the benefit of trading these futures. Number one, high transparency and regulation, because there is a high transparency and regulation in these types of forex type. The second one is great for hedging against the currency fluctuation. So it is a good way if you want to hedge against the currency fluctuation. But mainly this type of trade is not meant for everybody. I get my point right now. Then number three, standardized contract size and expiration dates. So they have standardized contract size and also have expiration date. In despite of everything that have advantage have disadvantage. Are you getting my point right now? So let me tell you the drawback of this type of forex. Number one is less flexibility compared to spot trading. So there are less flexibility compared to spot trading. And number two, may require larger capital. So people who are trading this type of market are people who have a huge amount of money, who have large capital in their disposal. Mainly the big firm, the big company, and all the big organization are mainly the type of people that are trading this type of forex, these futures currency. Are you getting my point right now? So let's continue. Number three, currency forward. Currency forwards. A forward contract is similar to a future, but it is a private agreement (OTC), meaning over the counter, between two parties, often by business to hedge currency exposure. So a forward contract is similar to a future, but it is a private agreement or over the counter between two parties, often used by business to hedge currency exposure. For example, let me give you example, because in everything I'm teaching you in this my channel, I love to give you example so that you'll be able to understand what I'm teaching. Are you getting my point right now? Let me continue for this example. A Nigerian importer agrees to buy goods from the US and locks in an exchange rate for USD Nigerian naira 3 months ahead. This protects them from unexpected currency depreciation. For example, right now I'm in Nigeria and I want to import goods from the United States. So 3 months ahead. So what I will do is that I will have to, hedge my position and buy that goods 3 months ahead before the currencies devaluate. So what I'm doing this is to protect myself, for unexpected currency from unexpected currency depreciation. Understand? Because currency depreciates sometimes, most of the times. So in order to protect myself as an importer, and in order not to add more money when importing goods, I have to hedge my position long ahead before the goods comes in my country. Are you getting my point right now? So let's continue. Why is this type of trading used? Why is it useful? Which is the advantages, understand, or the pros of these types of trade? Number one is customizable contract size and maturity. So one of the advantages is that it has customizable contract size and maturity. Number two, effective hedging tools for international business. So this type of trading is mainly done by people who are into international business, who are into importing and exporting. So they're mainly done by international business transaction. Are you getting my point? So let me tell you the second part, which is the limitation of this type of trading. Number one is not trading on exchanges. So this type of trading is not traded on exchanges, unlike the normal spot trading. No, this type of trading is not being traded on any exchange. So, and also mean that there are less liquidity and transparency. So there are less liquidity in this type of trading and also transparency. Number four, let's continue with the number four type of currency, which is number four types of forex type, which is currency options. Options give you the right but not the obligation to buy or sell a currency pair at a specific price before or on a certain date. So the what options does is that it gives you the right but not an obligation to buy or sell a currency pair at a specific price before or on a certain date. So there are two types of option. Number one is call option, which is right to buy, and put option, which is right to sell. So call option mean you are bargaining the right to buy, and put option means that you are bargaining the right to sell. Let me give you an example. You buy a call option for Euro USD at 1.100. If the price rises by 1.1200, you can exercise your right to buy at 1.100 and profit from those differences. Are you getting my point right now? So let me tell you the advantages of these types of option. Number one, limited risk. There are limited risk in this type of trading. you can only lose the option premium. Understand? So you can only lose the option in premium. Number 2, high leverage potential. So this type of trading have a high leverage. Are you getting my point? And they have a high leverage potential, meaning that this type of trading is not meant for everybody. Understand? Because it exposes your account at a very high risk. Number 3, strategic flexibility. So this strategic flexibility means that you can profit in both rising or falling market. So this type of trading, you can profit whether the market is on the upside or whether the market is on the downside, meaning you can profit from both the rising market and also you can both profit from both the falling market. Are you getting my side? Are you getting my point right now? So despite in all this advantage, what have advantage also have disadvantage. So let me tell you the downside of this. Number 1 is option pricing can be complex. So options pricing can be complex. This is the advantages of this type of trade. Number 2, premium may be expensive for volatile pairs. So for volatile pairs, option premium may be very expensive. So but mainly this type of trade is being done by big banks, hedge fund, big organization who are controlling millions and billions of dollars. So this type of trading is not meant for individual day traders or swing traders. But the reason why I'm breaking all this thing down for you so that you can be able to understand everything aspect of the foreign exchange market. Are you getting my point right now? So that is why I'm breaking everything down for you step by step. Are you getting my point? So let's continue. Number 5, contracts for differences, which is CFDs. So this CFDs is now where the individual traders and the swing traders and day traders are in. Contract for CFDs, contract for difference, or CFDs. So CFDs are derivative products that let traders speculate on price movement of currency pairs without owning the underlying assets. Are you getting me now? So CFDs are derivative products that let traders to speculate on price movement of currency pairs without owning the underlying assets. So CFDs is a product that allow us real traders, to be able to buy and sell, the a particular currency or the other, and also without even us owing the currency or the asset in our physical hand, but it can be able to speculate whether it will go up or it will go down. So in this type of forex, you can earn or lose money based on the difference between the entry and exit price. So are you getting my point? So in this type of trading, you can earn or lose money based on the differences between the entry, which is your entry price, and also your exit price. So if the trade goes in your favor, you will make money, and if the trade goes against you and hit your stop loss, you will lose money. Are you getting my point? So let's continue. So let me give you example of this type of trading is you open a CFD position on GBP USD at 1.2500 and close it at 1.2600. You profit from the 100 pips differences. So if you minus 1.2500 from 1.2600, so the difference is 100 pips. So you have made 100 pips profit in this type of market trading. So let me tell you the benefit of trading the CFD. Number 1, access to multiple markets. So in CFD, you have access to multiple markets you can trade off. Are you getting my point right now? So in CFD, you have access to multiple markets. You can trade the forex market. You can trade the forex market. You can trade the stock market. You can trade the indices, and also you can trade the commodities. So these are different opportunities that are in these CFDs, which is contract for derivatives. So number 2 is that trade long and short easily. So you can trade long or short easily, meaning you can buy or sell easily an asset. So whether you are buying a particular pair or selling a particular pair, you can do it very easily. Whether you are buying a particular stock or selling a particular stock, you can do it very easily. or whether you are buying a particular commodity or selling a particular commodity, you can do all these things very easily. That is why I like this CFD very, very well. And also use of leverage. In this type of opportunities, you can make use of leverage, because leverage is the money loaned to you by your broker for you to amplify your gain and at the same time amplify your loss. So this type of forex, which is the CFD, you can make use of leverage depending on the amount of leverage that your brokerage firm gave to you. Then let me tell you the disadvantage of CFD, because everything that have advantage also have disadvantage. Number one is high leverage amplifies losses. So high leverage amplifies losses, which I have already explained before. What is high leverage? High leverage are leverage amount more of money needed that your broker gives to you for you to amplify for you to double or make more money. And at the same time, if it goes against you, you lose more money. Understand? So it's more of a money that your broker loans you for you to trade more. So that is it. Number two is subject to overnight swap fees. In CFD trading, they are subject to overnight swap fees, in the sense that this type of trading is mainly people who are into swing trading. So if you are the person who trade or leave trade overnight, you will incur a swap fee. For the trade to flow to go on to the next day, there are fees or charges that your brokerage firm collect from your trading in order to keep that trading steady on your trading account. So it is being called swap fee. Are you getting my point right now? So these are basically the two disadvantages in this type of types of trading, which is the CFDs. So let's continue. Now let us compare this forex instrument that we have. Comparing forex instrument. So you have the instrument, you have the market type, you have the ownership, you have the leverage, you have the common use, and have the best for. Number one, spot forex. You have spot forex. Spot forex is the type of market is over the counter market, and there is no ownership. Are you getting me? There is no ownership, and also it uses high leverage, and also it also makes use of speculation. You can speculate, understand? And also it is commonly used by best for retail traders. Are you getting my point right now? Then futures instrument, futures instrument. So at the type of trading, but the market type is exchange based. Then there is no ownership, and also there are moderate leverage to compare the spot forex, and also it's commonly being hedging and trading. So it is not being speculated. It is being more of hedging and trading, and also it is best for institutional and experienced traders. So this type of instrument are mainly used by institutional and experienced traders. Are you getting my point right now? Then we have the forwards option. So forwards option it forward so forwards is an over the counter type of trade, and also there is no ownership in it, and also it is customizable, and you can also hedge against the inflation, especially if you are importer or exporter. But mainly it is commonly used and best used for for corporation, which I have told you before, or for the big company. Then we have option traders. Option traders are mainly used by the exchange or over the counter, and also there is no ownership, and also the leverage is variable. So it is variable, it is not constant, and also you can hedge and at the same time you can speculate. Then but mainly it is being done by commonly used by experienced traders. So if you're not experienced, you can't do these kind of things. Are you getting my point right now? To avoid losing your head and to avoid losing your hard-earned money. So then we have the last one, which is the CFDs, which is the one everybody, most of all the individual traders do, including me. The CFDs is the market type of OTC. It is being done over the counter. Then the ownership, there's no ownership. Then also it makes use of high leverage, which amplifies your gain at the same time amplifies your losses. Then commonly used for speculation. So we are speculating on the currency, whether the currency will go in the upward direction, which is the buy, or whether the market will go short, which is the sell, depending. It is called speculation. We are speculating. Then it is best for retail and professional traders. So this type of this type of instrument are being used by retailers and professional traders. So now let me ask you this question: which instrument should you trade? So now I'm gonna be telling you which type of instrument you should be focusing on as a beginner or as someone who is starting out to the journey of forex trading career. Are you getting my point right now? Then your ideal instrument depends on the following. Number one, your trading goal. Is your goal this? Are you hedging or speculating? This is the first question you need to ask yourself. Are you hedging or speculating? Number two is your capital. Futures and forwards needs more capitals, while CFDs and spot forex allow smaller position. So if you are into futures and forwards, you need more capital for you to trade this type of instrument. But if you are into CFDs and spot forex, then you are being allowed to make use of smaller position and smaller amount of money to start trading. So you don't necessarily need bigger amount of money for you to start trading. If you're into CFDs and if you're into spot trading, you can start with literally $10, $20, $50, $100. Understand? So, but if you're into futures and forward, you can start from at least for like $100,000, $200,000. So, but that is why I tell you this one is mainly for big firm and corporation. But the CFDs and the spot forex is mainly for smaller and individual traders who are starting out just to make money from the forex market. Then the third one is your experience. Beginners usually start with spot forex or CFD. So as a beginner who is venturing into the forex market new, you will start with the spot forex or the CE for the and CFD for simplicity. I get my point. So as a beginner who is starting out in forex trading, you will start with the CFD or spot forex for simplicity. Then if you are new, start with demo account. Are you getting my point? If you're a new trader, you need to start with demo account. By this, you need to go to your Google Play Store or your Apple Store and download the MT4 or MT5, whichever one you prefer. Then you need to start, to trade demo, because when you open this trading app, you'll be given a stimulated currency, a virtual money that you can be trading and beginning experience, but the money you can't withdraw it because it is a fake money. Are you getting my point now? So what you need, what this thing helps you is for you to test how this instrument work before risking your real money. So this thing helps you and gives you opportunity for you to test these currencies, these instruments, before investing your real hard-earned money. Are you getting my point right now? So let's continue. Then my key takeaways is this: forex instruments are the different tools or contracts used to trade or hedge in the currency market. That is number one. Then the main ones include the spot forex, the futures, forwards, options, and CFDs. Are you getting my point right now? Then number three is each instrument are unique. Understand? So not just that, they have advantage, they have risk, and also they have market structures. Are you getting my point? And also knowing how they differ helps you choose the best fit for your strategy. This is one thing I want to tell you. Knowing how this instrument differs helps you to choose your strategy, your budget and your experience level as a trader. Are you getting my point right now? Let me give you for example. If you are new to the forex market, you'll be going more of the CFDs. Are you getting my point right now? You'll be going more of the CFDs and the sports forex. But if you are an organization or corporation, these people are going for futures. So there's no need of you going for futures, since you're a beginner and an individual who just want to make money from trading the forex market. So you'll be going with CFDs or spot trading. So And my final thoughts: mastering forex trading isn't just about predicting market direction. It is about understanding the instruments you use. So that is why I tell you, mastering forex trading is not just about predicting the market direction. When it goes up, you buy, and when it goes down, you sell. No, but it is about understanding the instrument that you are trading. Are you getting my point right now? And also, whether you are hedging risk with forward, or trading short term with spot forex, or exploring option for leverage, each choose opens new ways to profit and new challenges to manage. Are you getting my point? So before you place your next trade, ask yourself, do you truly understand the instrument you are using? Understand? Because in the world of forex, knowledge is real power behind every successful trade. Are you getting my point right now? So before you place your next trade, ask yourself, do I truly understand the instrument I'm really using? This is very, very important question, because you need to ask yourself whether you really understand the instrument that you are trading before you start diving into that instrument. Are you getting my point right now? So let's continue. The next thing that I'm going to be teaching you right now is spot forex. Understand the habit of currency market. So what is spot forex, and why is it the heartbeat of the currency market? Are you getting my point right now? So let's continue. When people talk about forex trading, they really almost always referring to spot forex, the most popular, liquid and accessible form of currency trading in the world. So spot forex is the most popular, liquid and accessible form of currency trading in the world. Are you getting my point right now? So whether you are a complete beginner or an experienced trader, understanding how to spot forex works is essential, because it forms the foundation of your entire foreign exchange market. So understanding how to spot forex work is essential. It is very, very important for you as a beginner to understand how to spot forex. Understand? So it is very, very important as a beginner for you to understand this, to know the foundation of the entire foreign exchange market, or for the entire foreign exchange business. Are you getting my point right now? So in this section, we will explore everything you need to know about spot forex, what it is, how it works, and why millions of traders around the world trade it every single day. Are you getting my point? So let's continue. What is spot forex? Spot forex refers to buying and selling of currency for immediate delivery, meaning transactions are settled on the spot. So spot forex is the immediate buying and selling of currencies, meaning that the transactions are settled on the immediate spot. So in simpler terms, it is the exchange of one currency for another at the currency market price, called the spot rate. So in simpler terms, it means the exchange of one currency for another at the current market price, called the spot rate. Then the trade is typically settled within 2 days, within 2 business days. Although most brokers handle this automatically behind the scene. So most brokers automatically handle these things behind the scene. So your duty is to place trade, and your broker duty is for them to execute your trade for you. Understand? So let me give you an example. Let's say that the Euro USD, like I always say, I will be using the Euro USD as an example. Let's say the Euro USD exchange is 1.100. This means that 1 euro is equals to $1 10 US dollars. Understand? So if you believe the euro will rise against the dollar, we can buy the Euro USD. If the exchange rate rises to 1.1100, you can close your position and profit from the differences. Understand? You never actually hold physical euro. No, your profit or loss is calculated electronically based on price changes. So you don't need a physical euro for you to trade in the forex market. No. So you are actually being traded on electronically. You are actually trading with your smartphone or with your laptop. Understand? And your profit and loss is being calculated electronically based on price changes. Are you getting my point right now? So let's continue. Let's continue from where we stop. How to spot forex? How spot forex works? Understand? So every business has its operation. So I want to tell you now how spot forex works. The spot forex operates through an over-the-counter network. So we call it the OTC. So the spot forex market operates through an over-the-counter network, meaning there is no centralized exchange. Understand? There is no centralized exchange, unlike the New York Stock Exchange or the Japanese Stock Exchange that have a centralized network. This type of the spot forex market have a decentralized network, which means it is being done over the counter. Are you getting my point? So it does not have any centralized exchange, unlike the New York Exchange in the United States. So instead, it is a global network of banks, financial institutions, brokers, and retail traders like me and you. So instead, this type of trading or this type of forex, which is spot forex, is a global network of banks, financial institutions, brokers, retail traders like me and you. Are you getting my point right now? So when we are talking about banks, we are talking about the big banks, which are the JP Morgans, the Bank of America, the HSBC, Bank of England, Bank of Japan, all these big banks. Are you getting my point? So this is the type of bank we are talking of. Then we have the financial institution, which are the hedge funds, the investors. Understand? Then you have the brokerage firm, the people who facilitate trades for individual traders or retail traders, as the case may be. Then we have retail traders, who are me and you. You understand? Which is me and you who want to study forex trading. Understand? So the centralized structure allows trading 24 hours a day, 5 days in a week across all major financial centers worldwide. So this decentralized structure allows 24 hours trading, 5 days in a week across all major financial centers in the world, from from Sydney to Tokyo, London, and New York, because we have the New York session and we have the Tokyo session, we have the Sydney, and we have the New York. So these are the different centers, financial centers of the world, where this transaction is being done. Because, for example, the moment the New York people are awake, the London might be sleeping. So the moment the London might be sleeping, the Tokyo is active. So all the financial centers around the world are active 24 good hours. So that is why it starts from Monday to Friday, which is 24 good hours, 5 days in a week. I get my point. So let's now dive in straight to the key features of spot forex. So there are key features of spot forex, which is number one, because I break it down in feature and description. Number one, settlement. Settlement usually within 2 business days. Then leverage. In this leverage, traders can control large position with small capital. And like I have told you before, leverage is an amount or is money being loaned to you by your broker for you to trade. Are you getting my point right now? Then we have market hours. The market hour runs 24 hours in a day, and from Monday to Friday. Then we have liquidity. Liquidity means extremely high, which means that over $7 trillion is being traded daily in the forex market. For those of you who don't know, this market, over $7 trillion is being traded every single day from Monday to Friday. Then instruments, we have the major, we have the minor, and we have the exotic currency pairs. So these are the instruments that is being traded in these types of forex, which is spot forex. Then let's continue. Advantages of spot forex trading. So because in everything that have advantages is also have disadvantages. But right now I'm telling you the advantages of spot forex trading. Number one, high liquidity. Spot forex is the most liquid market in the world. This means that you can enter or exit trade instantly at nearly any time without major price slippage. Are you getting my point right now? It means that high liquidity, there is too much amount of money flowing in the market, and you can buy and you can sell almost instantly, and you can enter the trade instantly, and at the same time you can come out of the trade instantly, almost immediately, once you see that you have made a decent amount of money. Are you getting my point? So, and at nearly any time without major price slippage. So you can do it anytime without any major price slippage. Then number 2 is low transaction cost. So spread, which is the difference between the bid and ask price, are generally small, making trading costs very low. So the second advantage is that it have a low transaction cost, especially on major currency pair like the Euro USD or GBP. Are you getting my point? So you have a low transaction cost in this type of trading, unlike other type of trading. Number 3 is leverage opportunities. So most forex brokers offers, example, 1:100, 1:500, or even way more higher, which allows traders to control large position with smaller amount of money. Like I have already explained back to back, leverage are money loaned to you by your broker for you to amplify more money, and at the same time for you to lose more money if the trade goes against you in the market. Are you getting my point right now? So however, leverage can magnify both your profits and losses, so it must be used wisely. That your broker is giving you a high leverage doesn't mean that you use it without applying wisdom. No, when you're making use of leverage, apply wisdom. Make sure you use it wisely so that you won't burn out your trading account. Are you getting my point right now? Then let's continue. Number 4, 24 hours market. Unlike stock market that open and close at fixed times, the forex market runs continuously during weekdays, letting traders from all zones participate. So unlike the stock market that opens and close at a fixed times, are you getting my point right now? The forex market is way different because it runs continuously during the whole week. You understand? It runs from Monday, Tuesday, Wednesday, Thursday, Friday, which let traders from all time zone, whether from New York, whether from London, whether from Tokyo, whether from Sydney, whether from Australia, whether from Germany, to participate at any time once they are on Monday to Friday section. Are you getting my point right now? Number 5 is accessibility. You don't need a huge amount of money or complex paperwork to start. All you need is just a trading account and internet access, and also a basic understanding of how currency pairs works. So you don't need a huge amount of money like $10,000, $20,000, for example, or complex paperwork for you to start. No, all you just need is just a trading account that you have registered with your broker, and internet access, and also a basic understanding of how the currency market works or how the currency pairs works. That is what you need to learn and understand, how the currency or how the forex market work, before you start diving in and before risking your hard-earned money. Are you getting my point right now? Let's continue with risk of spot forex trading. So like I was telling you before, everything that has advantage have a disadvantage. Let me tell you the risk of spot forex trading. While spot forex trading offer amazing opportunities, it also comes with significant risk, and here are the few to be aware of. So for the fact that the spot forex trading offered an amazing opportunity, that doesn't mean that it doesn't have risk. No, there are risks involved in spot forex trading, and I will be listing out the risk for you, and also at the same time I will be explaining everything for you to be aware of the risk involved in spot forex trading. Are you getting my point right now? Number 1 is leverage risk. High leverage can turn small market move into a large losses. High leverage can turn a small market move into a large losses if you're not being careful. That is number 1. Risk management like stop loss order is crucial to protect your capital. So what you need to do is to apply a proper risk management by putting your stop loss order, which is very, very, very important, and which is very, very crucial for you to protect your capital, for you to protect your hard-earned money. Understand? So make use of leverage wisely and don't overmax your account. because you are being given a high leverage. Are you getting my point right now? So apply proper risk management and be conservative with your trading. Are you getting my point right now? Number 2 is market volatility. Currency prices can change rapidly due to news events, interest rate decision, or geopolitical tensions. So this volatility can lead to both high profit and steep losses. So market volatility, currency prices change rapidly. Are you getting my point? Especially when there are news events, when there are the news from Federal Reserve, which is in America, when there are news from Bank of Japan or Bank of England, or interested decision from different central bank, or geopolitical tension. For example, when there are, let me say, earthquake or some violence or some things that is happening in the country. This volatility can lead to both high profit and at the same time steep losses in the market if you're not very careful. Number 3, broker reliability. Let me tell you something. Since the spot forex is an over-the-counter market, which is OTC, choosing a regulated and trustworthy broker is essential. Are you getting my point right now? As someone who is trading the forex market, choosing a regulated and trustworthy broker is essential. Always verify regulation under authorities like FCA, that is in the United Kingdom, ASIC, that is in Australia, NFA or CFTC, that is in the United States, or CYSEC, which is in Cyprus. These things are regulated authorities who make sure that they regulate brokerage firm. Understand? Who guide the brokerage organization and they oversee the activities. So you need to check your brokers whether they are regulated under these major people. If they are not being regulated under these people, my brother, be very, very careful with the type of that brokerage firm, because they might take your money. Even if you make money, you might not withdraw the money. So that is why for you to make use of a trustworthy and a regulated forex brokerage firm before anything, so that you won't lose your money whenever you make profit. You can't withdraw it. It doesn't make sense, because our goal in this market is for us to make money. So it doesn't make sense that you make money after everything you can't withdraw the money. So that is why you need to make use of a regulated broker that is highly regulated and trustworthy. You understand? So let's continue. Emotional trading. Because forex trading is fast paced, it is easy for emotions like fear or greed to take control. Successful traders follow a strategy, not impulses. So emotional trading is also the risk involved in this in spot forex. So because forex trading is a fast paced, or it's a fast paced business. Understand? So it is easy for emotion like fear or greed to take control. Understand? So that is why successful traders follow a strategy and not impulses. That is why you need to control your emotion and control your psychology whenever you are in the market. So don't allow your emotion to take part of you in your trading. Rather, follow a rule-based system, or have a strategy and a rule-based system that helps you to trade and also manage your risk and also manage your emotion at the same time. Are you getting my point? So let me give you an example how a spot forex trade works. So let me give you an example of how a spot forex trade works. For example, let's say that you open a trading account with $1,000 and you use 1:100 leverage, allowing you to control $100,000 worth of Euro USD. Then the exchange rate moves from 1.1000 to 1.1050, a 50 pips gain. Are you getting my point right now? So your profit, each pips is worth $10 on a standard lot size. 50 pips times $10 is equal to $500 profit. Are you getting my point right now? Assuming that you are buying a standard lot of 1.0, which means that for every pip movement you are making $10. For every pip movement you are making $10. Then then you are able to make a profit of 50 pips. Then that 50 pips times $10 will give you $500 profit. Are you getting my point right now? Then if the market move the other way around, are you getting my point? If the market move against you, you will lose the same amount of money, which means you will lose a $500, showing why risk control is vital. So let me say, for example, if the market move against you, you will lose the $500 instead of you losing the $1,000 in your trading account. So you are still left with $500. You are still left with $500 for you to trade the next time. And that is why risk management and risk control is very, very vital whenever you are trading the forex market. Are you getting my point right now? Then let me now tell you what is different between spot forex versus other instruments. So spot forex versus other instruments, what they are and why are they important. Number one, futures. Spot forex futures, the options and forwards. Settlement. In settlement in spot forex, it settles 2 days or immediate, but the settlement of the future is the future date. Then also options, they are flexible, and I getting my point. At the same time, the forward has a constant date. Then their market type, spot forex is over the counter market. Are you getting my point? Then the futures are exchange based, the option are exchange based and also over the counter, while the forward is over the counter. Then the flexibility for forex is high, while the futures is moderate. Then the options is moderate, and also the forward is high. Then ownership, spot forex there is no ownership, the futures there is no ownership, the options there is no ownership, as well as the forwards there is no ownership. Then typical use, spot forex is speculations, futures there is both hedging or speculation. Then in options they are hedging, and in forwards they are hedging. Are you getting my point right now? So these are the differences and the similarities. These are what differentiates spot forex from other forex instruments. Are you getting my point right now? Then spot forex is ideal for traders who want to speculate on short-term price movement or take advantage of real-time market volatility. So spot forex is ideal for traders who are just new in the market. I want to make money, I want to make money and withdraw within the shortest period of time. Spot forex is for you. And you want to take advantages of real market volatility, then spot forex is for you. So let me tell you the tips for successful spot forex trading. Number one, understand currency pairs. You need to understand how the base and both currency works. Are you getting my point? So if you haven't watched my video that I explain more on the base and core currency, you can check out my episode 1 of this course that I explain everything in detail. What are the base currency and what are the core currency? But don't worry, I will still explain all of them in this video for more and more clarity. Are you getting my point right now? Then number 2, learn to manage risk. By that I mean use stop loss and limit orders. So make use of stop loss and at the same time make use of limit orders for you to manage your risk in spot forex trading. Number 3, trade with discipline. So when I mean trade with discipline, it all boils down to stick to your trading plan and strategy. So you need to stick with your trading plan and you need to stick with your strategy. Number 4, use technical or fundamental analysis. So as a spot forex, as someone who is into spot forex trading, you need to make use of technical and fundamental analysis. Combine sharp pattern with economic data. Are you getting my point? Number 5, start with a demo account. So you need to practice before using your real money, which I have already told before. You need to practice very, very well before investing your real hard-earned money in this type of business. Are you getting my point right now? That is where demo account is very, very important. And that is why I told you need to go to Google Play Store or your Apple Store if you are using an iPhone. Download your MT4 or MT5, meaning MetaTrader 4 or MetaTrader 5. When you download it, you open your demo account and start trading with your a fake money. And we are trading with the fake money. The more you learn, the more you test your strategy, the more you test your strategy, and the more you understand the market, and the more confidence you get. That is why you can say, okay, I'm good with this. Let me now invest my real money. Are you getting my point right now? So let me give you my key takeaways in this thing, which is spot forex is the direct buying and selling of currencies at the market price. Also, it is the most active and liquid part of the forex market, which I've already explained before. And also, it offers high leverage. Also, it have 24 hours access and low cost, but also very, very, very high risk. Are you getting my point? Then it is suitable for traders who want to speculate on short-term currency movement. So it is suitable for traders who want to speculate on short-term currency movement. And also, success in spot forex comes from knowledge, discipline, and strong risk management. Are you getting my point right now? Then let me tell you my final thoughts in this spot forex trading. Spot forex trading is exciting, fast-paced, and full of opportunities. Are you getting my point right now? It is the core of the global currency market, giving traders around the world a chance to profit from price movement in real time. However, behind every winning trade lies discipline, patience, and education. So before you jump in in this spot forex trading, make sure you understand how spot forex works. Because in forex, the best investment you can make is in your own knowledge. Are you getting my point right now? So the best investment you can make in forex trading is to invest in education, is to invest in your knowledge. And for you to make money consistently in forex trading, you need to be disciplined. That is number one. And also you need to be patient, which is number two. And also you need to educate yourself, which is number three. So I don't want to overemphasize on these things. Trading requires discipline, it requires patience and education. So let's continue to the next topic in this my episode 3, which is forex futures. Are you getting my point? Forex futures. So I taught you about spot forex trading. Now I'm going for forex futures. And forex futures, I'm not telling you a complete guide to trading currencies in the future. Not in the future of next 5 years, but in the future of an asset. Then let's continue. When you hear about forex trading, most people think of buying and selling currencies in the spot forex market, which I just finished right now, where trades happen instantly. But there are another powerful way to trade currencies, one that offers more structures, regulation, and strategic flexibility. It is called forex futures. So in this context, we will break down everything you need to know about forex futures, what they are, how they work, their advantages and disadvantages, and how they compare to other forex instruments. Are you getting my point right now? Let's continue. What are forex futures? Forex futures, also called currency futures, are standardized contracts that allows traders to buy or sell a specific currency at a predefined price on a set date in the future. So it is a standardized contract that allows traders to buy or sell a specific currency at a predetermined price on a set date in the future. So unlike spot forex, which is traded over the counter, futures are traded on a regulated exchange. Are you getting my point? So unlike spot forex, which is being traded over the counter, the futures are being traded on a regulated exchange, such as the Chicago Mercantile Exchange, CME. So you can go check it out on the internet, the Chicago Mercantile Exchange. So they are the exchange that facilitate the mixture of the futures. So in simple terms, forex futures are agreements to exchange one currency for another at a future date, but at a price decided today. I get my point. So forex future is an agreement to exchange one currency for another at a future date, but it will be at the price decided today. Are you getting my point right now? So this allows traders and businesses to hedge against currency risk or speculate on future currency movements. So what it does is that it allows traders and businesses to hedge their money against the currency risk and also to speculate on future currency movements. So are you getting my point right now? Then let me now talk about how forex futures work. So how does forex future work? A forex future is a binding contract between two parties. Are you getting my point? So it is a binding contract between two parties in the sense that the buyer agreed to purchase a currency at a specific rate in the future. Also, the sellers agreed to sell that currency at the same rate. Are you getting my point? So each futures contract has these things. It has a currency pairs like the Euro USD or GBP USD or GBP JPY and so on. Also, it has a contract size, which is the amount of currency being traded. Then it has an expiration date or an expiring date, which is when the business will expire. And also it has a set price. So it has a set price, meaning at the agreed exchange rates between the individual and the company or the exchange platform. That is what I mean. Let me give you an example, because like I always say before, in my teaching I love giving people example for you to understand what I'm teaching you. Let's say you believe the euro will strengthen against the US dollar over the next 3 months. You buy 1 euro USD future contract at 1.100 set to expire in 90 days. If the euro rises to 1.1300 by expiration, your contract becomes more valuable and you can sell it for a profit even without ever owning physical euro. I get my point. So let's continue. What are the characteristics of forex futures? Characteristic of forex future and its description. Number 1, exchange traded, which is it is being traded by organized exchange like Chicago Mercantile Exchange. Standardized contract. By this description I mean it has a fixed contract size and expiration date. Regulated. It is being supervised by authority like the CFTC in the United States. Leverage means it's offered through margin trading. Then the settlement, it can be physical or cash settled. So it can be physical or cash settled. Then transparency, prices and volume are publicly available. So the transparency of this business is that the prices and volume are publicly available. I get my point right now. Then the major currency futures traded on exchange. So for example, let me tell you the major currency futures traded on the futures exchange. And here are some of the most commonly traded forex futures contracts. Are you getting my point? So here are the list of most commonly traded forex future contracts. I will tell you the currency pair, the exchange symbol, the contract size, and the exchanges. You have the Euro USD. The exchange symbol is 6E, and the contract size is 125,000 euros. And the exchange is the Chicago Mercantile Exchange. You can go check it out on the internet or you can browse it on your Google. Number 2 is the GBP USD, and the exchange symbol is 6B, and the contract size is 62,500 pounds. And you can check it out on the Chicago Mercantile Exchange. Then the third one is USD JPY, which is the exchange symbol is CJ, and their contract size is 12.5 million Japanese yen. You can go check it out on the Chicago Mercantile Exchange. Then we have the AUD USD, which the exchange symbol is 6A, and their contract size is 100,000 Australian dollar. And the exchange is Chicago, and the exchange is also Chicago Mercantile Exchange. Then we have the USD Canadian dollar with exchange symbol 6C and contract size of 100,000 Canadian dollar on the exchange platform of Chicago Mercantile Exchange. Then we have the USD Chef with exchange symbol 6S and the contract size of 125,000 CHF in the Chicago Mercantile Exchange. So each contract value speculates based on currency price movement. So by this, it means that each contract value it fluctuates. Are you getting my point now? Each contract values fluctuates based on currency price movement, just like forex, just like spot forex, but within the rules of a formal exchange. Here is why traders use forex futures. Are you getting my point? So here are the reasons why traders make use of forex futures. Forex futures aren't just for big corporations. They are also used by speculators, hedge funds, and professional traders for different reasons. Are you getting my point? So this forex futures is not just being used by big corporations or hedge funds. No, it's also being used by speculators, hedge funds, and also professional traders for different reasons. Number one, hedging currency risk. Are you getting my point? Let me explain. Current companies that operate internationally often use futures to lock in exchange rates and protect themselves from currency fluctuation. Let me give you for example. A US company expecting to receive 1 million euro in 3 months might sell Euro USD future to hedge against the euro weakening. So for example, let me say a US company is expecting to receive 1 million euro in the next 3 months. So what they need to do is that they might sell their Euro USD futures to hedge their position against the euro if it weakens. I get my point, for them not to lose money in the future. Then number two is speculation. Traders buy or sell futures contract to profit from currency movement, just like the spot forex traders, but with more structure and transparency. So like I said in this part, which is speculation, that traders buy or sell futures contracts to profit from currency movement, just like spot forex traders, but with a more structure and transparency. So in future, there is a more structure and more transparency. Are you getting my point? Then number three, arbitrage. Arbitrage means professional traders sometimes exploit small prices differences between spots, forex, and futures markets to earn risk-free profit, a strategy known as arbitrage. Are you getting my point right now? So professional traders sometimes exploit small price differences between the spot forex and the futures market to earn risk-free profit, and the strategy is known as arbitrage. Now, let me tell you the advantages of forex futures. Are you getting my point? The advantages of forex futures. Number one, regulated and transparent. Forex futures are traded on regulated exchanges, ensuring fair pricing and publicly available data on prices and volume. So forex futures are being traded on regulated exchange like the Chicago Mercantile Exchange, and also it ensures fair pricing and also publicly available data on prices and volume. Number two is no counterparty risk. No counterparty risk means that since the exchange guarantees each contract, there is no risk of default from other party, unlike in over-the-counter forex trading. So since the exchange guarantees each contract, there is no risk of default from the other party, unlike the over-the-counter forex trading. Number three, standardization. Contract terms like size, expiration, and settlement are fixed, making it easy to understand and trade. Then number four, effective hedging tools. Businesses and investors uses forex future to stabilize to stabilize future cash flow by locking in currency rates. Then number 5, high liquidity. Major currency futures like the Euro USD and the GBP USD are extremely liquid, allowing easy entry and exit. So major currency futures, which are the Euro USD, the GBP USD, and AUD USD, are extremely liquid, which allows easy entry and exit position. So now let me now tell you the disadvantages of forex futures, because everything that has advantage also have disadvantage. Number 1, fixed contract sizes. So each futures contract has a fixed size, which may not suit smaller traders or those who prefer flexibility. That is number 1. Number 2, limited trading hours. Unlike 24-hour spot market, futures trading follows exchange hour, limiting global accessibility, which is number 2. Number 3, less variety. While spot forex offer hundreds of pairs like major, minor, and exotic pairs, the futures market only lists a handful of the most traded currency. So just more like in spot forex trading, you can see the major currencies, you can see the minor currencies, and you can see the exotic currency pairs. But in futures, the future market, they only list the handful of the most traded currency in the financial markets. Are you getting my point? Number 4 is margin call. Because futures are leveraged products, adverse price movement can trigger margin call if your account balance falls below maintenance requirements. For example, let me give you an example. Profit and loss in forex future trade. Let's revisit the earlier example that I give you before. You buy one euro future contract at 1.100. Each tick 0.001 equals to $12.50 per contract. After 1 month, the price rises to 1.10550. Your profit, 50 ticks times 12.50, is $625 profit. So if the price falling to 1.0950, then you lose $625 instead. Then forex futures versus spot forex. Now let me tell you the difference between the forex futures and spot forex. Let me tell you the futures, and let me tell you the way and how it falls. The market type: spot forex is over the counter market, while forex future is exchange traded. Then the settlement: immediate or 2 days immediate, but the forex futures is future date. Regulation: brokers dependent, and also forex future is highly regulated. Contract flexibility: customizable, but in forex future it is standardized. Leverage: in spot forex you can go up to from 1:100 to 1:500, but in forex futures you can go very low, from 1:10 to 1:50. Then in the trading hours, in spot forex you can trade 24 hours in 5 days, while the forex future is being limited to exchange hours. Then who are these things best for? Spot forex is best for retail traders, while forex future is best for institutional and professional traders. Are you getting my point right now? So now you will now ask yourself, who should trade forex futures? Forex futures are best suited for, number 1, the institutional traders who need transparency and regulation. So this forex future is best suited for institutional traders who need transparency and regulation. Number 2, corporation managing international risk. Corporations managing international risk. Number 3, professional traders using hedging or arbitrage strategy. Also, professional traders who are making use of hedging or arbitrage strategy. Are you getting my point right now? So if you are a beginner, listen, spot forex might be easier to start with. But if you prefer structure, regulation, and less counterparty risk, forex future can be an excellent option. But my key takeaways is this: forex futures are contracts to buy or sell a currency at a future date for a predetermined price. 2. It is being traded on regulated exchange like CME or OTC, which is over the counter. Number 3. It is great for hedging and speculation. Number 4. It offers transparency, regulation, and standardization, but have less flexibility than spot forex. Number 5. Understanding both futures and spot trading helps you choose the best method for your goals. So understanding both the forex futures and also spot trading helps you to choose the best method for your goals. Then in my final thought in this topic, forex futures are a cornerstone of the global forex market or currency market, providing safety, structure, and opportunity for traders and corporations alike. While they may seem more complex than spot forex, they play a vital role in managing risk and maintaining currency stability worldwide. So if you are looking for a way to trade currency with clear rules and reliable oversight, forex futures might be your next big move. Just remember, knowledge and discipline remain your greatest asset. So you need to know this. Knowledge and discipline remain your greatest trading asset. So you need to have the knowledge, which is number one. That is why I'm teaching you this. And also, you need to be disciplined so that you can be successful in this type of trading. Are you getting my point right now? So let's continue from when we stop. Now, let's move to the next topics, which is the forex option. So forex option is a complete beginner. So this forex option, a complete beginner's guide to flexible currency trading. So I've already taught you the forex spot, forex futures. Now I'm teaching you forex option. Now you'll be wondering, what are forex option? The forex market is filled with different instruments. The spot forex, which I've already told you, futures, which I've already told you, forwards, and more, and one of the most flexible tools of all, which is forex options. Now I have already taught you about spot forex, futures, forward. Now I'm teaching you about forex options. So let's continue. While spot forex is commonly traded, forex option give traders the ability to profit from currency movement without being forced to buy or sell currency outrightly. So while the spot forex is commonly used and is commonly traded, forex option gives traders the ability to profit from currency movement without being forced to buy or sell the currency outright. So in this section, we will break down exactly what forex options are, how they work, the different types, the advantages and disadvantages, and whether they are suitable for you. Let's continue. What are forex options? Forex option or currency option are financial contracts that give the buyer rights but not the obligation to buy or sell a currency pair at a fixed price before or on a specific date. The key here is right, not obligation. This flexibility is what makes option unique. Are you getting my point? So in simple terms, a forex option lets you choose whether or not to execute a trade in the future, depending on whether it benefits you. So it is like buying an insurance policy that protects you against unfavorable price movement, while still allowing you to profit if the market moves in your favor. So key terms in forex option. Before diving deeper, here are some essential items or essential terms you need to know in forex options. Number one, which is strike price, the price at which you can buy or sell the pair in the future. Number two, expiration date, the date on which the option contract expires. Number three, premium, the cost of buying the option. You pay this upfront and it is non-refundable. Number 4, call option. Call option gives you the right to buy a currency pair at a strike price. Number 5, put option. Put option gives you the right to sell a currency pair at a strike price. I get my point right now. So let's move ahead to how forex option work. So you need to know how forex option work, and I will now be breaking it down for you. Let's imagine you expected the Euro USD pair to rise soon, but you're really not 100% sure. You can buy a call option on Euro USD with a strike price of 1.100, expiration date which is 30 days, and premium which is $100. So in this first scenario, price rises to 1.1300. Your option becomes profitable. You exercise it or sell the option contract for a profit. Then in second scenario, price drops to 1.0900. It means that you do nothing. You simply lose the $100 premium, nothing more. So this limited losses and unlimited potential gain makes option attractive for risk management. I got my point right now. So it have a limited losses and unlimited potential gain, which makes option attractive for risk management. Then let me now tell you types of forex options. Number 1 is vanilla options. These are types of common and simplest form: call option, put option. So there are two types of vanilla options. We have the call options and we have the put options. Then, which are used for hedging or speculation. I go to my point right now. Then we have the exotic option. Exotic options are more advanced, often used by banks and large institutions. So the exotic option is being used by banks and large institutions. I got my point right now. And the example include binary options, barrier option, Asian option, and digital option. And all these come with unique rules, risk level, and payout structures. I get my point. Then we have number 3, exchange traded options. So exchange traded option offered on regulated exchange. So this exchange traded option are being offered on a regulated exchanges, and also they are highly transparent and at the same time standardized and safer. Number 4, we have over the counter or OTC option. So it is customized contracts offered by brokers or banks. Also, they are more flexible but riskier because the market is not centralized. I get my point right now. So over the counter option, they are more riskier because the market is not centralized. But why traders use forex? But ask yourself this question: why traders use forex options? Forex options are versatile tools. They can be used by corporations, investors, and retail traders alike in these following ways. Number 1 is hedging. Hedging. Business use options to protect themselves from unfavorable currency movements. Let me give you an example. A US company importing goods from Europe buys a Euro USD call option to lock in a maximum possible Euro purchase cost. Number 2, speculation. Traders use options to bet on price movements, often with less risk than spot forex. Then number 3, risk control. With option, you know your maximum possible loss upfront, which is the premium. Number 4, strategic flexibility. There are dozens of option strategies such as straddles, strangles, spreads, and butterflies. This can be used to profit in trading or ranging markets. Now, what are advantages of forex option? Because everything that have an advantage also have disadvantage, but right now we are focusing on advantage. Number 1, limited risk. Your maximum loss is the premium you paid, no margin call. Number 2, high flexibility. So you can choose to strike price, So you can choose strike price, you can choose expiration date, you can choose contract types, and also you can choose direction. Number 3, you can profit in any market. So with option strategies, you can profit when prices rises, and at the same time you can profit when prices rise, and at the same time you can profit when this price moves sideways. Are you getting my point? Then number 4, hedging power. The options are widely used by companies and institutions to manage currency exposure. So options, this type of trading mainly are widely used by companies and institutions to manage currency exposure. So they are not mainly open to the traders. No, they are open for big companies and institutions who are into international transaction. I get my point right now. So now let me tell you the disadvantages of forex option, because I told you now this is the disadvantages of forex option, because everything that have advantage have disadvantage. Now let's focus on the disadvantages of forex option. Number 1, premium cost. Option can be very expensive during a high volatility. Yes, it can be very expensive during high volatility. Number 2, complexity. Some option, especially exotic option, requires advanced knowledge. So you need to have advanced knowledge if you want to trade exotic options. Number 3, time decay. Option lose value as expiration approaches, even if the market moves slightly in your favor. Number 4, lower liquidity. Not all currency options are actively traded. Example of forex option. So not all currency options are actively traded. That is why there are low liquidity in forex option. In forex option. Now, let me give you example of forex option of profit and loss. Let me break it down in a simple example. Let me say, for example, you buy a GBP USD call option. Then your strike price is 1.2500. Then your premium is more of like your stop loss is $120, and your expiration date is 30 days. Number 1, the first scenario is if the price rises by 1.2700, your profits from the difference is 200 pips gain. Option payoff equals to $200 minus 120 equals to $80 profit. Then the second scenario, if the price stays at 1.2500, then you lose the premium of that $120. Third scenario, if the price fall, the third scenario is price fall. Then this price fall, if you also lose the momentum, then that is minus $120. This clear risk to reward structure is why many traders love options. I'm getting my point right now. Then let's now go the differences between the forex option versus the spot forex. Understand? So here are the differences in the futures. In the obligation, spot forex trade are executed, while the forex option is the one that you choose. Number 2, which is the futures, is your risk. In spot forex, there are unlimited risk without stop loss, but forex option is limited to premium. Then the leverage. In spot forex we have high leverage, but in forex option we have low leverage. Then profit potential. In spot forex we have high profit potential, and also in forex option we have high profit potential. Then in terms of complexity, spot forex there are low complexity. Then forex option have medium or high complexity. Then spot forex is best for beginners, while forex option is best for intermediate and advanced traders. I get my point right now. So let's continue. Why should you trade forex option? If I may ask, or if you may ask yourself, why should you trade forex option? Number 1, forex option are ideal for traders who want limited risk. If you want limited risk, forex option are ideal for you. Number 2, investors who want hedging tools. If you are an investor who want hedging tools, it is ideal for you. Number 3, traders with intermediate or advanced experience. If you are a trader with intermediate or advanced experience, then it is for you. Number 4, those using strategic or multiple leg trades. If you are using strategic or multi-leg trades, it is for you. Then businesses needing currency protection. So if you're in a business, most especially the importers or exporter that need currency protection, then it is for you. Then for absolute beginners, spot forex might be easier to start with. So for absolute beginner, if you're a beginner, spot forex trading is what I would recommend for you to begin with. So then my key takeaway is this: forex option gives you the right, not obligation, to buy or sell currency in the future. Number 2, they are great for hedging and speculation. Number 3, your maximum loss is always the premium. Number 4, it offers strategic flexibility and unmatched by forex instruments. Number 5, best suited for traders who understand risk management and market structure. I'll get to my point right now. Then my final thoughts on this forex option is this: forex options are one of the most powerful tools in currency trading world. They allow you to protect your money, limit your risk, and profit from different market conditions like rising, falling, or even sideways market. While they may seem complex at first, once you understand how they work, options can elevate your trading to a whole new level. So if you're really building a comprehensive forex career, I need you to go through forex option, which is very, very essential if you want to go into forex option. Are you getting my point right now? So, but in all these things, you need to have an edge, and it gives you an edge that why other traders don't have, in the sense that some traders just go for normal spot trading and just straightforward spot trading and start trading. But you need to understand all these things and understand how they come about, so that you'll be grounded in the business of forex. Are you getting my point? So are you getting my point right now? That is why I'm taking my time to break everything down for you. Are you getting my point? Now let's move ahead to the next topic in this our episode, which is currency swaps. So what are currency swap? What they are, how they works, and why they matter in global finances. So in this section, you understand what are the currency swaps, how they work, and why are they important in the global finance. Are you getting my point right now? Let's continue. In the global financial world, large corporations, governments, and institutional investors constantly deal with currency risk. It is a normal thing. Once the global financial world is involved, large corporations, government, big banks, institutional investors constantly deal with currency risk. And it is true. Exchange rate fluctuates. You understand? Exchange rate fluctuation can dramatically affect profits, debt repayment, and international trades. Are you getting my point right now? So to manage this risk, one of the most powerful tools they use is currency swap. Are you getting my point? So while most retail traders never directly trade currency swap, understanding them gives you a deeper insight into how international finance truly works. Understand? So while most retail traders never trade directly the currency swap, but you who is watching this video, you having the understanding gives you a deeper insight into how the international finances truly works and how forex markets behave the way they do. In this section, we will break down what currency swaps are, how they function, their benefits, risk, real life example, and how they compare to other forex instruments. Let's continue. What are currency swaps? A currency swap is a financial agreement between two parties to exchange currencies and interest payments over a specific period, and then swap them back at the end of the contract. Unlike spot forex, which is immediate exchange, or futures exchange at a predetermined date. The currency swap involves exchanging both principal and interest in different currencies. So in simple terms, a currency swap is a long-term agreement where two entities swap money in different currencies today and reverse the exchange later while paying each other interest along the way. So they are one of the most important tools in international finance. Then you have to ask yourself, how do currency swaps work? Currency swaps involve two exchange transactions. Number one, initial exchange, which are that both parties exchange the principal amount in two different currencies. Example, company A gives company B $100 million and company B gives company A $90 million. So this exchange uses the current spot rate. So number two, ongoing interest payment. Both parties pay interest to each other on the amount they receive, but at the interest rate set in the respective currency market. Example, company A pays interest to company B at the euro interest rate, and company B pays interest to company A at the US dollar interest rate. Number three, final exchange at the end of contract. At the maturity, both companies swap the original principal amount back in the initial exchange rate. This protects both parties from currency fluctuation during the contract. Types of currency swap. Currency swap comes in several forms depending on what the parties need. Number one, fixed for fixed currency swap. So we have different types of currency swap, and one of them is fixed for fixed currency swap. So in this fixed and fixed currency swap, both parties pay fixed interest rates in their respective currencies, used when companies want predictable payments. Number two, fixed for floating currency swap. One party pays fixed interest while the other party pays floating or variable interest linked to market rate like LOIBOR or the Euro IBOR. Number three, floating for floating currency swap. Both parties pay interest at floating rate in different currencies, often used by large banks and individual or institution. So these floating for floating currency swap are mainly used by large banks and institutions. For example, hedge funds, JP Morgans, the Bank of America, the HSBC, Bank of America, then the Bank of England, the Bank of Japan, and also institutions like, let me say, for example, the Toyota, maybe they want to buy their product from their rubber for another currency of the Toyota company, the Mercedes Benz, all these big companies that are making use of floating for floating currency swap. Then number four, cross currency basis swap. So number four type of currency swap is cross currency basis swap, one of the most common forms in global finance. And here is this: principal amounts are exchanged at the beginning and end, which is number two. Interest payments are floating on both sides. And thirdly, used heavily in international debt market. So these cross currency based swap are mainly used by countries who are borrowing from another country. Understand? So this number four, which is cross currency basis swap, are mainly used for interest rate payments and also mainly used for international debt market. But it's basically meant for different countries of the world. If they are borrowing each other, that they are being paid, they are borrowing money at a particular exchange rate, and they're paying the money at a particular exchange rate. And understand? So let's continue. Why are currency swap used? So why are currency swap used? This is a very, very important question you need to know. Currency swap are powerful tools with many reward applications. Number one, hedging exchange rate risk. Let me explain. Companies with international operation use swap to avoid unpredictable currency fluctuation. Example, a US company borrowing in euro can swap it with another company can swap it with another company to avoid euro volatility. Number 2, access to cheaper or better financing. A company might get a better interest rate in its home currency compared to foreign market. So swaps allow each party to borrow where they get the best rate and then swap into the currency they actually need, which is number 2. Number 3, lowering borrowing cost. When two companies swap loans, both parties may benefit from lower interest rates. Number 4, matching cash flow with foreign revenue. If a company earns revenue in foreign currency, it may swap its loan payment into the same currency to reduce risk. Then number 5, support for central bank operation. Central bank uses swap to do the following. If you don't know, central bank of the world are making use of currency swap. Yes, because they are one of the majority people who are making use of this type of forex, which is the currency swap. 1, they are using it to swap to stabilize the currency market. So they make use of these things to stabilize the currency market. Number 2, they make use of it to provide foreign currency liquidity. And then number 3, they make use of this to strengthen national financial system. So a well-known example is this, the Federal Reserve dollar swap line with foreign central banks during crisis. So let me give you real-life example of how this currency swap works. Let me break down a simpler example. So I want to break it down for you to understand what I mean by this. In the first scenario, company A is in the US. So let's take for example that the first company is in the US, which is company A. And let's say that the company B is in the Europe. So company A needs euro, and then company B needs the dollar. Are you getting me now? So let me say for example that the company A needs the euro and company B needs the dollar. The first step is this. What is the initial exchange? Let me say A gives B $100 million and B gives A 90 million euro based on the current exchange rate. Step 2, ongoing interest payments. A pays B interest based on euro market rate, and B pays A interest based on US dollar market rate. Step 3, final exchange. A returns the 90 million euro. A returns the 90 million euro and B returns the $100 million because the exchange rate was locked in the beginning. Neither party suffers from currency fluctuation. So now, let me now head over to the advantages of currency swap. Yes, advantages of currency swap, because currency swap have its own advantages. Number 1, protection from exchange rate risk. Businesses avoid unpredictable currency movement. Number 2, lower borrowing cost. Companies borrow where rates are cheapest and then swap. Number 3, access to foreign markets. Businesses gain funding in foreign currencies even if they can't easily borrow abroad. Number 4, flexible interest payment structure. Fixed, floating or mixed, companies choose based on their needs. Number 5, long-term stability. Currency swap often last several years, making them suitable for long-term projects. Then disadvantages of currency swap, because like I always say, anything that have an advantage also have disadvantage. So let's talk about the disadvantage of currency swap. Number 1, complexity. Swap requires deep financial understanding, legal agreements, and risk modeling. Number 2, counterparty risk. If one party defaults, the other may face losses. Number 3, not for retail traders. So this type of trading is not for retail traders. These are institutional instruments and not accessible to everyday forex traders. So this type of trading, which is currency swap, are not meant for retail traders. No, So these are for institutional instruments and they are not accessible for forex traders like me and you. Number 4, requires strong credit rating. Companies with poor credit may not qualify for swaps. So it requires strong credit rating. That is why companies with poor credit may not require this for swap. Then let's now go. What is the different features between currency swap versus forex forward and versus forex futures? Now, I have already broken down for you the futures, the currency swaps, the forex forward, and the forex future. Number one feature is the purpose. Currency swap, their purpose is for long-term funding and hedging, while the forex forward, their purpose is for short-term hedging, while the purpose for forex futures are speculation and hedging. Then interest payment. Currency swap have interest payment, yes, while forex forward did not have any interest payment, so as forex future they don't have interest payment. Exchange of principal. Currency swap have twice, while forex forward have once, and forex future have no exchange of principal. Then the type of market. The currency swap is over the counter market, the forex forward is over the counter market, and forex futures is exchange traded market. Then the complexity. The currency swaps have high complexity, while the forex forward have medium complexity, and then the forex futures have low complexity. Now, who uses currency swap? You may ask, who uses currency swap? Currency swap are mostly used by, number 1, multinational corporation. And by multinational corporation, I mean the likes of Japan, the likes of Toyota as a big company, the likes of Microsoft, the likes of Google, the likes of Tesla. All these big companies are making use of currency swap. Number 2, large commercial banks. By large commercial banks, I mean JP Morgan, Bank of America, HSBC. All these all these top banks in the world make use of currency swap. Number 3, central banks. Yes, central banks of every government or every country make use of currency swaps. I get my point. So central bank of every country make use of currency swaps. Number 4, government. Government of different countries make use of currency swap in borrowing and financing their budget. They make use of currency swap when they want to borrow money to finance their project or to finance their yearly budget. I get my point. Then number 5, institutional investor. Institutional investor make use of this currency swap because they are using it in their business. I get my point right now. So they are essential tools for managing a global financial risk. So these currency swap are the essential tools for managing the global financial risk, because every single day the currency and the money fluctuate. So as the currency fluctuates every single day, the currency swaps helps in maintaining balance and also reducing risk exposure for the big banks, for the multinational corporation, for the central banks, and also for the government in terms of their interest rate and whatsoever, and also for the institutional investors, because an investor wants to make profit when he is investing. So he doesn't want to expose the risk of him losing the currency valuation. I got my point right now. Then they are essential tools for managing global financial risk, which I've already talked about before. Then let me talk about the key takeaways on this very topic. The key takeaway is this: a currency swap is a long-term agreement between two parties for exchange principal and interest in different currencies. Number 2, it is used for hedging, lowering costs, and managing foreign exposure. Number 3, they protect companies from exchange rate volatility. Number 4, it is mostly used by institutions and not retail traders. So if you're a trader, this type of trading currency swap is not meant for you. No, they are mainly used by institutions, like by big banks, by big corporation, by government, by central bank, and institutional investor are the people who are using this. But day traders or retail traders are not meant to make are not doesn't have access to this type of currency swap of trading. Are you getting my point? So the only people that have access to it are the big banks, the hedge funds, the government, and central banks are the only people who have access to currency swap. It is not meant for the trade traders. That is the short and simple part of everything I'm saying right now. Then my final thoughts on this topic. My final thought is this: currency swap may seem complex at first, but they are one of the most influential tools in the global financial market. In the global finance, currency swap are the most influential tools in the global finance. They help nations stabilize their currencies, allow companies to manage international risk, and keep the global economy running smoothly. By understanding how the currency swap works, you gain a deeper insight into the forces influencing forex prices, international trade, and global monetary policy. Are you getting my point right now? So by understanding the currency swap, you'll be able to know and understand how the forex price move, and also how the international trade works, and also how the global monetary policy work. So these things will help you to give you more insights on how the how the forex market work, and how price is being influenced. Are you getting my point? So that you know that the price is being influenced by the central banks, by the big corporation, and by the central banks of different countries, like Bank of America, Federal Reserves, the Bank of Japan, the Bank of England, and so many other banks, central bank of the whole world. Are you getting my point right now? So that is why you need to have this clear and understanding of this currency swap in order not to make any mistake when you are starting out in trading the forex market. Are you getting my point right now? So let's now dive into the one that everybody is trading, which is the CFDs, which is the contract for difference. The CFD means contract for difference. This is the one that both the retailers and the professional traders are in, both me and you are into. So this is the one that we'll be making use of, which are the CFDs. Let's now work in. And now I'm gonna be giving you a comprehensive guide on this. So today, trading in today's financial markets goes beyond simple buying or selling assets. Are you getting my point? One of the most popular and flexible trading instruments used by millions of traders around the world is the CFD, meaning contract for difference. Whether you trade forex, stock, commodities, or indices, understanding CFD is essential. So in this guide, you will learn what CFDs are, how they work, their advantage, risk, and whether they are suitable for your trading style. I get my point. So in this section, you will learn what are CFDs, how they work, their advantage, risk involved, whether they are suitable for you or not. Are you getting my point? Then let's continue. What are CFDs? A contract for difference, CFD, is a financial agreement between a trader and a broker to exchange the differences in an asset price movement from the moment of trade is open to the movement when trade is closed. Let me say it again. A contract for difference is a financial agreement between a trader and a broker to exchange the differences in assets when price from the moment the price is open to the moment when the price is closed. This means that you don't own the underlying asset. Number one, you speculate on price movement, which is number two. And number three, you profit from the difference between the entry and exit prices. Let's continue. CFDs allow traders to trade many markets without owning the physical asset. Then let's continue. How CFD works. Here is a simple breakdown on how CFD works. Number one, choose a market. You can choose the Euro USD, you can choose the gold, you can choose the Tesla stock, whichever wish you are trading. Number 2, you buy or long trade if you expected the price to rise, or sell or short trade if you expected the price to fall. Then number 3, you close the trade. By this is mean when you open your MT4 and you want to place a trade on the Euro USD, you buy when the market is moving upward and you sell when the market is moving downward. Then if you give you the profit, or if it is your stop loss, then you close the trade and you are gone and you are done for the time, for the day. By this it means if price moves in your favor, you profit, and if price moves against you, you lose. So you only pay the differences in price, not the full value of the assets. I get my point right now. So you only pay the differences in price and not the full value of the assets. Let me give you an example. If you buy gold at $2,000 and close it at $2,020, it means that the difference is there is $20, which becomes a profit multiplied by your position size or the loss size. So let's now continue. Assets you can trade as CFDs. So what are the assets that you can trade as CFD? So CFD are incredibly versatile. You can trade. Number 1 is Forex pairs. You can trade CFDs with Forex pairs. If you are trading the Forex with the Euro USD, GBP USD, GBP JPY, all the Forex pairs you can trade with it. Number 2, stocks. You can trade stocks because stocks are CFDs. You can trade indices like S&P 500, the Nasdaq. You can trade commodities like gold, oil, silver. All of them are under CFDs. Also, you can trade cryptocurrencies like BTC USD, Ethereum USD, and other cryptocurrency pairs. Also, you can trade bonds as CFDs. You understand? Then you can trade ETFs. So all these things are CFDs. So this wide range cover that makes CFD attractive to both beginners and advanced traders. So this wide coverage makes CFDs very attractive for both beginners and advanced traders. I get my point right now. So now, what are key features of CFD trading? So you need to understand what are the key features of CFD trading. Number 1, leverage. Leverage allows you to control a large position with a smaller amount of money, which is margin. Let me give you an example. One of the key features people like CFDs is leverage. I'm giving you an example. With 1 to 50 leverage, you deposit $100. You can control a $5,000 position. Number 2, long and short trading. CFD allows you to make money whether market rises or whether market falls. You buy, which is long, when the profit moves goes up, and you sell or short when profit price goes down. Number 3, no ownership of the asset. You are trading price movement and not a physical asset. So this reduces costs such as shortage, storage, stamp duty, or transfer fees. Number 4, wide market access. All major global markets are available from one trading platform. Now let me now tell you the advantages of CFD, because CFD has its own advantages. So these are the advantages of trading CFDs. Number 1, low capital requirements. Thanks to leverage, you don't need thousands of dollars to start. So you can start with as low as $50. You can start trading CFDs. Number 2, ability to hedge. CFD can protect your portfolio from losses by opening opposite trade. Are you getting my point? So CFDs can protect your portfolio from losses by opening opposite trades. Number 3, flexibility in market conditions. You can trade any market direction and switch between assets easily. Are you getting my point? You can trade any market direction and switch between assets easily. Number 4, no expiration date. Unlike futures and options, CFDs have no expiring date. You can hold as long as you want, but watch rollover fees. So you can hold CFDs as long as you want, but you need to be very careful on the swap fees or your rollover fees, whichever way you may call it. Then let's go at the risk of CFD trading. Let's go over to what are the risks associated to CFD trading. CFD trading has advantages but also significant risk. Number one, high risk due to leverage. There are high risks due to leverage. Number two, leverage magnifies profits but also losses. A small price move can wipe out your account if not risk is not managed. Number two, overnight fees. Holding position overnight attracts swap or financing fees. Number three, market volatility. Price can change rapidly, especially during news events. Number four, broker dependency. CFD are over-the-counter products, meaning you rely on your broker's pricing and execution. Then you ask yourself this question: is CFD trading good for beginners? CFD trading is powerful, but beginners must approach it with caution. So it is suitable if you understand risk management. Like I have already said before, you can handle leverage products, and also you practice on a demo account before risking your real money. So it is not ideal if you want risk-free or slow-paced investing. So CFD is not ideal if you want to risk-free or slow-paced investing. Are you getting my point? Now, how to start CFD or how to start trading CFD, whichever way you want it. Number one is this: choose a regulated brokerage firm or choose a regulated broker. Number two, open a demo or live trading account. But I will always advise you to first of all open a demo account before going to live account. Number three, deposit funds. Then number four, pick a market. So pick whether you want to stick with forex, stocks, commodities, etc., whichever way you want. Number five, analyze price movement. Then do your analysis in those currency pairs, which I will be teaching you on our more subsequent videos in this my section, how to analyze the markets. Then number six, open long or short trade. So after analyzing the price movement, it will give you whether you want to buy the asset or whether you want to sell the asset, whichever way you want to go with. But it is after analyzing the pair. Are you getting my point? Number seven, manage risk. By manage risk, I mean stop loss and position sizing. You need to set your stop loss and at the same time your position sizing. Then number eight, closing trade when ready. So close the trade when ready. Once you make the money, close out your trade. If you hit your stop loss, step out of the market. Then in conclusion, CFDs or contract for differences are one of the most flexible and accessible trading instruments available today. They give traders the ability to profit from rising and falling markets, use leverage and access to a wide range of global assets from one platform. However, CFD comes with significant risk, especially due to leverage. Successful CFD trading requires discipline, risk management, and continuous learning. So, if you want to understand how they work and use them responsibly, CFD can be powerful too in your trading strategy. So you need to understand CFD and understand how they work and also make use of them responsibly. Once you make use of them responsibly, you make a whole lot of money trading the CFD. Are you getting my point right now? Now, let's head over to the next topic, which is currency indices. Yes, of course, currency indices, which is example USD index. We call it DXY. Which is now let's head over to a complete guide for forex traders. So in this forex market, traders analyze currencies in many ways. Number one, forex or price action, fundamentals, sentiment, and market structure. But one tool many beginners overlook is currency indices. So these indices help traders measure the overall strength or weakness of a currency against the basket of other currencies. So one of the most popular example is the US dollar index, which is DXY. But several other currencies indices exist and other powerful market signals. So in this section, we will break down everything you need to know about currency indices and how to use them to improve your trading decision. Are you getting my point? So we are talking about the currency indices, which are what we call the XY. Are you getting my point now? What are currency indices? A currency index measures the value of a specific currency against a group of other major currencies. So think of it as a strength show card for a currency. So instead of comparing USD to Euro or GBP, an index shows how strong the USD is overall across multiple key currencies. So be asking yourself why currency indices matters in Forex. Currency indices help traders, number one, to identify the strength or weakness of a currency. Number two, spot trending market better. Number three, avoid trading currency that are neutral or consolidating. Number four, confirm trade setup using divergence. And number five, improve pair section or choosing strong versus weak pairs. Let me give for example. If the US dollar index, which is the DXY, is rising, it means that the dollar is strengthening across the board. Gives traders confidence to buy the USD pair like USD JPY or sell pairs such as the Euro USD. Popular currency indices. There are so many popular currency indices. So the forex market has several well-known indices, and here are the most important one. Number one, the US dollar index, the DXY. Yes, of course, we call it DXY. If you go to your trading platform or if you go to your trading view, search for DXY, you will see what I'm teaching you. The DXY is the most widely used currency index in the world. It measures the value of the US dollar against the basket of 6 major currencies. So the DXY basket is the composition of the Euro with 57.6%, the JPY with 13.6%, the GBP with 11.9%, the Canadian dollar with 9.1%, the SKE, which is a Singapore dollar with 4.2%, and Swiss franc, which is 3.6%. So the DXY is the basket of currency that composites this whole amount of currency by these different percentages. I'm getting my point right now. So the euros carry the highest weight, making the Euro USD the most influential pair on DXY. Are you getting my point? So number two, we have Euro index, which is EXY. So this EXY tracks the trend of Euro against the basket of global currencies. For example, it is usually used in analyzing the Euro USD, Euro GBP, and Euro JPY. Then we have JXY, which is the Japanese yen index. So it shows the performance of Japanese yen, which is very helpful for traders who trade JPY pairs like USD JPY and GBP JPY. I'm getting my point right now. Then we have the British Pound Index, which is BXY, which measures the GBP strength across key global currencies. Important when trading GBP USD, GBP JPY, and Euro GBP. Then we have other common currency indices. We have the CXY, which is the Canadian dollar index. You have the AAX, which is Australian dollar index. You have the ZXY, which is New Zealand dollar index, and we have the WXY, which composite world currency index. So these indices can be found on platform like TradingView, which I've already told you few minutes ago, that you can see all these things on your trading view. So you can go on trading view and check it out and look for it. When you look for it, you can be able to understand this thing I'm saying. I got my point right now. So now, how currency indices works, or how currency index works, that's the same thing. A currency index is calculated rise using a weighted average of exchange rate. Here is the idea. If the USD rises against multiple currencies, DXY increases. But if the USD weakens across the board, DXY decreases. So this creates a big picture, or a big view of the market sentiment towards that currency. I understand. So if the USD increases against multiple currency, DXY increases. And if the USD weakens across the other board, DXY decreases. Now let's continue. How forex traders use currency indices. So you need to ask yourself, how do forex traders make use of currency indices? Number one, currency indices are powerful tools in technical and fundamental analysis. Here is how traders use them. Number one is trend confirmation. Yes, trend confirmation. If the Euro USD is falling, but the EXY, which is the Euro index, is rising, the move may not be strong. But if the Euro USD is falling and the EXY is falling too, then the downtrend is more stronger. Number two, strong versus weak currency strategy. Successful traders often match the strongest currency versus the weakest currency. Are you getting me? Example, if the USD is strong, which is DXY is rising, and if the JPY is weak, which is the JXY is falling. Are you getting? Then traders prefer to buy the USD JPY. Number three, avoiding bad trading condition. When a currency index is flat, ranging, or unpredictable, trading its pair becomes riskier. Indices helps you avoid shopping markets. I get my point right now. Then number four, divergence trading. If a currency pair diverges from its index, it can signal a reversal. Example, DXY rising, Euro USD rising instead of falling. This often signals Euro USD might reverse soon. Number five, news impact assessment. After major economic events, interest rates, inflation data, employment reports, indices reveal the true global reaction to a currency. For example, after NFP or FOMC, traders shake DXY to confirm the USD strength. Benefit of using currency indices. Number one, clearer market direction. They show overall strength, not just the movement in one pair. Number two, better pair selection. Choose the right pair, improves winning rates and reduce timing error. Number three, stronger technical analysis. Indices often show cleaner trend and clearer breakouts. Number four, trading with confidence. You can confirm whether a currency is strong or weak before placing trades. Now let me tell you the limitation of currency indices. Why useful? Indices have limitation, which is the advantage. Number one, basket weight may not reflect current global trading balance, meaning that the euro has a heavy weight in DXY, which sometimes skews results. Number two, some indices are not standardized across brokers. I get my point. Not all brokers have DXY, so different platforms use different calculation method. Are you getting my point right now? And also number three, not available in all trading platform. Like I tell you, it is not available in all trading platform. But you may need platform like tradingview.com for you to see it. So if you head over to tradingview.com, search for DXY, you will see it. Are you getting my point right now? So in this final conclusion, here is what I want to tell you in this currency indices. Currency indices are powerful tools that every trader should understand and use. They provide a clear picture of global currency strength, help confirm market trend, and significantly improve trade decision. Are you getting my point? So the most popular index, which is the US index, DXY, is especially important because the USD is involved in most global financial transactions. But other indices like EXY, JXY, and BXY also play a crucial role in understanding cross-currency movements. So if you want to improve your trading accuracy, identify trend earlier, and avoid unnecessary losses, incorporating currency trade into your strategy is a smart and effective way. So in all these things, it is very, very good to incorporate currency indices in your trading, especially the DXY, which composes the basket of all currency pairs. Are you getting my point right now? So making use of the US dollar index is very, very important if you are trading. So it helps you to know the overall direction of the of the US dollar against other currency pair, or against the other major currency pair. I mean, so are you getting my point? So if you have watched this video up to this moment, let's head over to episode 4 of my full forex trading course. Now this one is the episode 3. Let's head over to episode 4 right now. Let's go to episode 4. Guys, hello guys, you are welcome back to my episode 4. So this is the episode 4 that you are watching right now. So let's continue from where we stop. You are welcome to my episode 4. Let's continue with this episode 4 right now. Technical analysis, the complete beginner's guide to reading the markets. Are you getting my point right now? So in this episode 4, I will be teaching you the technical analysis, which is the complete beginner's guide for reading the forex market. So everything that you need to know about technical analysis is in this episode 4. Let's continue right now. In the world of forex and financial trading, two major approaches help traders make decisions: fundamental analysis, which is the news and economic data, and technical analysis, which is charts and price movement. While fundamental explains why the market moves, the technical analysis shows how and when to trade. Whether you are a beginner or an intermediate or mastering technical analysis can dramatically sharpen your edge and help you understand market behavior with clarity. In this guide, we will break down what technical analysis is, how it works, and how traders use it to identify profitable market opportunities. Number 1, what is technical analysis? Technical analysis is the study of price movement, sharp pattern, and market behavior to predict future price direction. Instead of focusing on economic reports or global events, technical analysis uses the following things. Number 1, it uses price charts, it uses trend, it uses indicators, support and resistance, volume, and market pattern. The core belief behind this technical analysis is price reflects in everything. All available information, economic, political, and psychological, is already reflected in the price. So by analyzing price behavior, traders can anticipate future movement. The three core principles of technical analysis is because technical analysis is built in 3 timeless principles. Number 1, market action discounts everything. Every piece of information, news, data, expectation, emotion is already priced in the chart. That is number 1. Number 2, prices move in trend. Market moves in 3 ways. The market moves in uptrend, downtrend, and sideways or range. Understanding trend helps traders follow the market instead of fighting it. Number 3, history repeats itself. Human behavior is predictable. Pattern repeat because traders repeat the same action again and again. So this is why sharp pattern like double tops, head and shoulder, and triangle works. Then you ask yourself, why technical analysis is important for traders? Technical analysis helps traders for the following reasons. Number 1, identify entry point. Number 2, identify exit point. Number 3, manage risk effectively. Number 4, predict price direction. Number 5, find high probability trade setup. Number 6, understand market psychology. Best of all, technical analysis works across markets. So technical analysis works across all assets. Technical analysis works in Forex. Technical analysis works in stocks. Technical analysis works in crypto. Technical analysis works in indices, and as the same as technical analysis also works in commodities. So it works across all different types of markets. So it is very, very important for you to understand it. The key components of technical analysis. Let's break down the tools and concepts every trader must understand. Number 1, price charts. Charts are the foundation of technical analysis. The most common types are the candlestick chart. The most popular shows open, high, low, and close. Then we have line chart, which simply the trend representation. Then we have bar chart, similar to candlestick but less visuals. Candlestick charts provide the clearest insight into price movement, patterns, and sentiment. So we'll be making use of candlestick in this our course. I get my point right now. Then let's continue with number 2, trend. Understanding the trend is one of the most important parts of technical analysis, of technical trading. Uptrend moves in higher high and higher lows. We have the downtrend, which moves in lower low and lower highs. And we have the range, which price moves in sideways. It is neither moving higher low or it is neither moving lower low. So after teaching you this thing, I will go to my MT4 to break everything down and show it everything for you. But it will be on this video, but it will be continuous video. Well, once you are watching, you will see it in some clips of this video. So trader use trend line and moving average to identify trend direction. Number 3, support and resistance. Support are level where price trend to react. Support means a level where price stops falling and bounce up to buy opportunity, while resistance is a level where price stops rising and reverse down, which means selling. These are used to determine the entry point, stop loss placement, and take profit targets. Number 4, chart patterns. Patterns are visual formation that appears repeatedly in the market. We have reversal patterns. Under reversal patterns, we have head and shoulders, we have double top, double bottom, we have rising wedge, and we have falling wedge. Under continuation patterns, we have triangles, we have flags, we have pennants, and we have rectangles. Patterns help traders anticipate future price direction. Then number 5, we have technical indicators. Indicators uses mathematical formula based on price. They help us confirm trend or signals reversal. And here are the most popular categories. Number 1, which is A, we have trend indicator. Under trend indicator, we have moving average, either SMA or EMA. Number 2, we have MACD. Number 3, we have average directional index, ADX. We use them to measure trends and direction. They are called trend indicators. Number 2, which is B, we have oscillators. Under oscillators, we have RSI, which is relative strength index. We have stochastics, and we have CCI. So it is used to spot overbought and oversold condition and momentum shifts. So oscillators are used to spot overbought and oversold conditions and momentum shifts. Then number C, we have volatility indicators. Volatility indicators, we have Bollinger Band and also have average true range, ATR. It helps to identify price volatility and breakout potentials. Then D, we have volume indicators. Volume indicators, we have unbalanced volume, OBV, and we have volume profile. These volume indicators are useful for understanding market participation. I will get to my point right now. Then let's move to number 6, price action techniques. Price action is a branch of technical analysis that focuses purely on raw price movement without indicators. Popular price action concept includes candlestick pattern, where we have pin bar, doji, engulfing, etc. Then market structure. Under market structure, we have break of structure and liquidity zone. Then we have other blocks under price action. We have imbalance under price action, and also we have breakout and fake out, all of them under price action. So professional traders often rely heavily on price action for them to execute their buy and sell order. Then number 7, we have time frames. Technical analysis can be applied to any time frames. We have scalping, which is from 1 minute to 5 minutes. We have day trading, which is from 5 minutes to 15 minutes. And we have swing trading, which is from 1 hour to 4 hours. Then we have position trading, which is from daily to weekly. Multiple time frame analysis help traders to get clearer picture of market direction. So what multiple time frame analysis helps traders do is to have a clearer view and clearer point of view or clearer picture of the market direction. Then let's head over to the strength of technical analysis. What are the strengths of technical analysis? Number 1, it works in all markets and time frame. Technical analysis works in all market and time frame. It works in forex, it works in stock, it works in crypto, it works in commodities, it works in any market. Once they are tradable financial assets, technical analysis works on them. Number 2, helps identify high probability setups. It helps in identifying high probability setup. Number 3, visual and easy to understand. Technical analysis are visuals and are very easy to understand. Number 4, technical analysis combine well with risk management. So technical analysis are combined well with risk management. Number 5, technical analysis allow traders to react quickly to market changes. So technical analysis allow traders to react quickly to market changes. Let's continue. What are limitations of technical analysis? Number 1, indicators can lag. So all these indicators that I have already listed out for you, they have lagging features, meaning that sometimes they are sluggish. So they react mostly when the market have already reacted. Are you getting my point right now? Number 2, patterns are not 100% guaranteed. Number 3, over-analysis can cause confusion. So don't overanalyze a particular asset or pair. If you don't understand it, if you don't have a clearer picture of what is happening, just stay out of the market. Are you getting my point? Number 4, market manipulation can create false signals. Market manipulation can create false signals. Number 5, cannot predict major news event. So you cannot use technical analysis to predict major news event. I get my point. But for best results, many traders combine technical analysis plus fundamental analysis. So for you to get the best results, you need to combine both technical analysis and fundamental analysis. Let's continue. How to start using technical analysis as a beginner. So as a beginner watching this video, or as an advanced trader watching this video, how to start using technical analysis. Number 1, here are the simple roadmap to follow. Number 1, step 1, learn the basics. You have to learn the basics, which is the candlestick, trend, pattern, support and resistance. We should be learning all of them in this section. Number 2, choose a trading style. You need to choose a trading style. Scalping, whether it is scalping, whether it is day trading, whether it is swing trading. Number 3, you need to use only a few indicators. Don't use too much indicator, just use only a few indicators. Too many indicators cause confusion. Number 4, backtest your strategy. Check your strategy performance historically before starting using them. Number 5, practice on demo account. Gain experience without risking your real money. And number 6, create a trading plan. So you need to create a consistency leading to success. So you need to create a trading plan. And by this I mean consistency leads to success. Because once you have a trading plan, it will help you to discipline you consistently. Are you getting my point right now? So in my conclusion, in this technical analysis aspect of the intro, technical analysis is one of the most powerful tools in trading world. By understanding charts, patterns, trends, and indicators, traders can make more informed decisions and increase their chances of success. However, technical analysis is not magic. It requires practice, discipline, and proper risk management. When used correctly, it becomes a deeper and reliable method for reading the market and predicting future movements. Whether you are trading forex, stock, crypto, or indices, mastering technical analysis is your gateway to become a confident and consistent trader. Now, let's head over to support and resistance, the easiest guide every trader must know. So yes, now in this section, I'm gonna be teaching you the support and resistance, which is the easiest guide that every trader must know. So this is the easiest video that will break down everything for you about support and resistance. So let's continue. In technical analysis, no concept is more important or more widely used than support and resistance. These two simple, powerful tools form the foundation of price action trading, helping traders to identify potential turning points, trend continuation areas, and key zones where buying and selling pressure meets. So if you want to understand market structure, improve your trade entries, or boost your accuracy, mastering support and resistance is a must. So in this section, we will break down everything you need to know from the basics to advanced application. What are support and resistance? If I may ask you, what are support and resistance? Support is a price level where a downtrend is expected to pause or reverse because more buyers enter the market. So it means an area in your chart where there is a potential buyers in the market. Think of it as floor. So think of support as a floor that price is struggling to break below. Are you getting my point now? So think of support as a floor that price is struggling to break below. Are you getting my point right now? Then let's head over to resistance. Resistance is a price level where an uptrend is expected to stall or reverse because more sellers enter the market. So you need to think of resistance as a ceiling that price is struggling to break above. Are you getting my point right now? So you need to think resistance as a ceiling that price is struggling to break above. Together, this level marks important price zones where buyers and sellers fight for control. Then you need to ask yourself this question: why support and resistance matters? Support and resistance help traders in the following ways. Number 1, helps identify trend reversal. Number 2, spot potential entry and exit points. Number 3, set stop loss and take profit level. Number 4, understand market psychology. Number 5, it helps you avoid entry trades at the wrong time. And number 6, it helps you confirm breakouts and breakdown. So support and resistance, they work across all markets. So they work across forex, stock, crypto, commodities, and all time frame. So support and resistance works across all markets, and also they works across all time frame in the forex market or any other market. whether it is crypto or stocks. Are you getting my point right now? So let's continue. Types of support and resistance. So not all levels are the same, and here are the major types of support and resistance. Because some traders won't tell you the types of support and resistance, but there are different types of support and resistance, and I will break it down for you in this video. That is why I'm taking my time to explain everything in details for you, so that you won't be carried away. Number one, horizontal support and resistance. Yes, the first types of support and resistance is the horizontal support and resistance. These are the classic level most traders use. Example, previous highs and low, price floors and ceilings, or ranging boundaries. I get to my point now. So horizontal levels are often the strongest because they reflect clearer market memory. Number two, dynamic support and resistance. This moves with price and changes over time. So dynamic support and resistance, this move with price and change over time. Example, moving averages. Under moving averages, we have 20 moving average, we have 50 moving average, and also we have 200 moving average. Number two, trend line. Number three, we have channels. So dynamic support and resistance level acts as a support and resistance level as long as price respect them. Number three, trend line support and resistance. Connecting swing high or swing low creates diagonal support and resistance line. Understand? So uptrend equals to rising support and downtrend equals to falling resistance. So trend line helps traders identify trend continuation or potential breakout. Number four, psychological levels. These are round numbers that traders naturally focus on. So psychological numbers or psychological level are random numbers that traders naturally focus on. Number one, examples of psychological level number. For example, 1.000, 1.05, 1.050. We have 150.00, and we have 2000. So in small explanation, psychological level are random numbers that banks, hedge funds focus on when trading. I get my point now. So large round numbers act as psychological barriers. Are you getting my point right now? So they also act as support and resistance. Number five, Fibonacci support and resistance. Using Fibonacci retracement level like 38.2, 50%, and 61.8 Fibonacci, traders identify likely reversal zone. Number six, supply and demand zones. More advanced traders use broader zones instead of straight lines. Demand zone equals to stronger buying area, and supply zone equals to stronger selling areas. So this reflects institutional orders and imbalance areas. Then you ask yourself this question: how support and resistance work, which are the market psychology. This level exists because of human behavior, and here is how. Traders remember key levels. If price reverses at a level before traders expected it to react again. Number two, crowd psychology. People behave predictably in groups. Level become self-fulfilling as thousands of traders watches them. Number three, market makers and institutions. Large orders are placed at key levels, making them even stronger. Number four, stop loss clusters. Many traders place stop loss orders around support and resistance. This creates liquidity and amplifies reactions. Let's continue with the next step: how to draw support and resistance level. Here are simple rules for drawing clean levels. Number one, use significant swing high and swing low. So here are the simple rules on how to draw support and resistance level. Number one, use significant swing high and swing low. Number two, focus on high level with multiple touches. Number 3, draw zone, not tiny lines. Make sure you draw zones and not tiny lines. Number 4, use high time frame like the 1 hour, 4 hours, daily or the weekly time frame. Number 5, keep chart clean. Avoid too many lines. You need to keep your chart clean and also avoid too many lines. Then the more time price respect a level, the stronger it becomes. So you need to understand this. The more time prices respect a particular level in the market, the stronger that level becomes. Are you getting my point right now? Let's continue. Trading strategies using support and resistance. Now I'm going to be telling you in this section the trading strategy using support and resistance. So here below are popular ways traders can use this level. Are you getting my point? Number 1, reversal trading. What are reversal trading? Buy at support, sell at resistance. Yes, simple, effective and beginner friendly. So as a beginner, if you are looking for a strategy, make use of reversal trading. You buy at support and sell at resistance. It is very simple, it is very effective, and it is beginner friendly. But at the same time, you need to look for confirmation. Yes, you need to look for confirmation. By looking for confirmation, look for candlestick pattern like pin bar or engulfing. Look for divergence, volume spikes or trend weakening. Number 2, breakout trading. Price break through support and resistance can signal a strong move. Breakout can be a true or strong momentum or a false breakout, which is fake out. Always wait for confirmation. Number 3, retest trading or break and retest strategy. So one of the most powerful setup is step. If a price breaks resistance, which is number 1, then number 2, if price come back to retest the same level, then number 3, if the old resistance becomes the new support, then you enter your trade with confidence. Let's head over to number 4, which is using support and resistance with indicators. So combining levels with moving average or RSI or MACD or Bollinger Band, you can use support and resistance with indicator to enter your trade. Everything is up to you. Example, using RSI oversold plus support level will give you a high probability setup only if you do it very well. Number 5, range trading. When price moves sideways between support and resistance, buy at support and sell at resistance. This type of strategies are mainly perfect for beginners, and here are common mistakes traders make. So you need to avoid this error. So you don't make this mistake when drawing support and resistance. So you need to avoid this common mistake traders make and also avoid this common error. Number 1, drawing too many lines or drawing too many levels in the market. Number 2, not using higher time frame. Number 3, expecting support and resistance to always hold. Number 4, trading without confirmation. It is very bad. And number 5, ignoring the overall trend. So support or resistance is a tool and it's not a guarantee. So the best practices for using support and resistance. So now I'm going to be telling you the best practices for using support and resistance. Number 1, use multiple time frame analysis. Number 2, combine a candlestick pattern. Number 3, confirm with indicators. Number 4, watch for strong price rejection. Number 5, be patient, wait for a clear signal. And number 6, manage risk with stop loss. Then, in conclusion of support and resistance are the foundation of technical analysis and price action trading. They are the word that reveal where buyers and sellers are most active, and it helps traders identify potential reversal and breakouts and provide reliable entry and exit points. By understanding this level and using them effectively, traders can drastically improve accuracy and confidence and consistency in the market. So you need to master this concept and you will be able to understand the market heartbeat, because support and resistance is the heartbeat of the financial market. So you need to understand it very, very well, because they are the foundation of technical analysis. I get my point right now. So right now, let's head over and continue with the next topic, which is trend line and channel. Mastering market structure for better trading. I get my point right now. So in technical analysis, understanding trend line and channel is essential for identifying market direction, key support and resistance area, and potential trade opportunities. These tools are simple, visual, and effective, making them favorite among both beginners and professional traders. In this guide, this will teach you everything you need to know about trend line and channels, including how to draw them, trade with them, and combine them with other tools to maximize accuracy. I'm getting my point right now. Then you'll be asking yourself, what are trend line? A trend line is a straight line drawn in a price chart to connect two or more significant points, usually swing high or swing low. So to illustrate the direction of the market, trend line are used for the following things. Number one, trend line is used to identify the direction of the trend. Trend line are used to identify, highlight, support and resistance level. And also, trend line are used to spot trend reversal. Also, trend line are used to confirm breakouts and continuation patterns. Let's continue. What are types of trend line? So we have different types of trend line. Number one, we have uptrend trend line, which is bullish trend line, which is drawn along a series of higher lows. Two, which acts as dynamic support and resistance. And three, which indicates that buyers are in control. They are the uptrend line or bullish trend line. Then number two, which is the second type of trend line, which is downtrend line or bearish trend line. It is drawn along a series of lower highs, and also it acts as a dynamic resistance line. Also, it indicates that sellers are in control. Number three type of trend line is horizontal trend line. It connects multiple highs or lows at the same price level, and often used to identify support and resistance zone. Now, you'll be asking yourself how to draw trend line. So now, in this section, you'll be learning and understanding how to draw trend line correctly. Number one is this. You need to identify the trend. This is number one. By this, you need to determine whether the market is moving up, moving down, or sideways. The first thing you need to do is for you to identify the trend first. You need to know whether the market is in the upside, which is moving upward, which is buy, or whether the market is moving downward, which is sell, or whether the market is in consolidation, which is ranging. Number two, you need to pick swing points. You need to choose at least two major lows for uptrend or two major high for downtrend. Number three, you need to draw the line. So you need to connect the points between with a straight line. Understand? Then number four, confirm the trend line. More touches validate its strength. A trend line with only 2 points is weaker than one with 3 points or more. I get my point right now. Number four, which are the tips for avoiding a trend line? It must naturally align with price action. I get my point right now. So here are the tips. To avoid forcing a trend line, it must naturally align with price action. Are you getting my point right now? Then you need to ask yourself, for you to draw a trend line successfully, it must align with the trend line, because if it doesn't align with the trend line, that means that trend line is invalid. Are you getting my point right now? Right now, let's head over to the next topic, which is what are channels? What are channels? A channel is formed when price moves between two parallel trend lines. In this section, we have the upper line, which acts as resistance, and we have the lower line, which acts as support. Channels visually capture price movement within a trend and help traders identify the entry and exit points, trends, and potential reversals. Then you ask yourself, what are types of trend line? Number one, ascending channel or uptrend channel. How do you identify this? Price makes moves in higher high and higher lows. The next one is that lower trend line is equal to support and the upper trend line is equal to resistance. Number two is descending channels or downtrend channels. Price makes lower high and lower lows. Uptrend channel trend line, which is resistance, and lower trend line, which is support. Then number three, horizontal channel, which are range bound markets. Price moves sideways, meaning upper line equals to resistance and lower line equals to support. Ideal for range trading strategy. But you ask yourself, why trend line and channel are important? Trend line and channel help traders in the following ways. Number one, identify trend direction. Uptrend, downtrend, or sideways market, trend line makes it clearer. Number two, spot entry or exit points. Buy near trend line support, sell near trend line resistance. Number three, trade breakout and breakdowns. When price breaks a trend line or channel, it may signal a strong move. Number four, combine with other tools. Indicators like RSI, MACD, and Fibonacci retracement work well with trend line and channel for confirmation. Number five, improve risk management. Placing stop loss order just below trend line support or above channel resistance reduces risk. Are you getting my point? Let's continue. Trading strategy using trend line and channel. So in this section right now, I'm gonna be telling you trading strategies using trend line and channels. Number one, trend line bounce trading. Yes, trend line bounce trading. Wait for price to touch the trend line. Number two, enter in the direction of the trend. And number three, place stop loss just below uptrend or above downtrend in the line. Number two, channel trading. Buy at low channel support, sell at upper channel resistance, which works best in a strong established channel. Number three, breakout trading. Price breaks through trend line or channel, enters in the direction of the breakout, and then confirm with volume or indicator for the liability. So in breakout trading, when price breaks through the trend line or channel, what you need to do is to enter in the direction of the breakout and then confirm with the volume or indicator for the liability. Number four, trend line confluence. Combine trend line from different time frame, then stronger trend line emerges where multiple trend line intersects. Common mistake traders make. So here are the common mistakes traders make when make use of trend line. Number one, drawing trend line on random point instead of swing low or swing high. This is number one mistake that traders make. Number two, ignoring the overall trend. When drawing the trend line, don't ignore the overall trend. Number three, trading every bounce instead of waiting for confirmation. Number 4, relying solely on trend line without other technical tools. Number 5, trend line on a low volume, volatile market without caution. Using trend line on a low volume, volatile market without a caution. So here are the common mistakes traders make, and you need to be very, very careful not to fall for these mistakes. Are you getting my point right now? The next thing is best practices for using trend line and channel. So in this very topic, you're gonna be learning best practices. What are the best practices for using trend line and channels when trading? So you need to know the best practices for using trend line and channel when trading. Number 1, use higher time frame for stronger signals like daily, 4 hours, and 1 hour. Understand, you need to use higher time frame for stronger signals like 1 hour, 4 hours, and daily. Number 2, look for at least 3 touches to validate your trend line strength. Yes, look for at least 3 touches to validate your trend line strength. Number 3, combine with support and resistance, candlestick pattern, and indicators. Number 4, draw channels as zones, not perfect lines. Price rarely touches exactly. Number 5, be patient and wait for confirmation before entering trades. In conclusion, trend line and channel are among the simplest yet most effective tools in technical analysis. They visually show the market direction, helps identify high probability trading opportunities, and improve risk management. By mastering these tools, traders can enter trade with confidence, spot trend, reversal, and breakout easily. Avoid trading against the trend because your trend is your friend. Combine with other technical analysis tools for maximum effectiveness. Understand? So you need to combine other technical analysis tools for maximum effectiveness when trading the trend line strategy. But in all this, whether you are trading the forex, stock, crypto, or commodities, trend line and channel should be an essential part of your trading toolkit. They are simple, visual, and timeless, yet extremely powerful when used correctly. Are you getting my point right now? So these are the things you need to know and understand. Let's head over to sharp pattern. Are you getting my point? Let's head over to sharp pattern, which is the ultimate guide to head and shoulder, double top, bottom, triangle, flags, and wedges. So in this section right now, you will learn about everything concerning the sharp pattern, because you need to understand the sharp pattern as a trader. Are you getting my point right now? So let's continue. In technical analysis, sharp pattern are one of the most powerful tools to predicting future price movements. They are visual formation on price and on price chart that repeat over time due to predictable traders' behavior. By mastering sharp pattern, traders can identify trend reversal, continuous, and potential breakout opportunity. I get my point right now. Then in this guide, we will break down the most popular sharp pattern and also explain how they work, and also provide practical strategies for trading them. I get my point. So let's continue. You'll be asking yourself, what are sharp patterns? Understand, what are sharp patterns? A sharp pattern is a specific formation created by the movement of price on a chart. This pattern reflects the psychology of buyers and sellers and often indicates whether a trend is likely to continue or reverse. Then sharp patterns are broadly categorized into two. Number 1, reversal pattern. It indicates a possible change in trend direction. And also continuation pattern, which suggests that the trend will continue. Number 1, head and shoulder pattern. The head and shoulder pattern is one of the most reliable reversal pattern. And look at the structure. The left shoulder, price rises and then falls. The head, price rises higher than the left shoulder and then falls. The right shoulder, price rises again, but not as high as the head. Then the neckline, a support line connecting the low of the left and right shoulders. So now the significances indicate a trend reversal from bullish to bearish. Number 2, inverse head and shoulder signals a reversal from bearish to bullish. Now, what are the trading strategy? Number 1, enter a trade when the price breaks the neckline. Number 2, place a stop loss above the right shoulder for a head and shoulder tops. Number 3, measure targets height from head to neckline projected downward. Number 2, double top, double bottom. These are classic reversal. Double top, which is bearish reversal. Price hits a high, pulls back, and then tests the same high again. 2, the neckline is the low point between the two highs. Then 3, a breakout below the neckline signals a trend reversal. Then we have double bottom, which is bullish reversal. Price hits a low, bounces, and then tests the same low again. The neckline is the high between the lows. A breakout above the neckline confirms a bullish reversal. Then let's talk about the trading strategy. Number 1, enter after the breakout. Place stop loss slightly beyond the second peak, which is double top, or second low, which is double bottom. Number 3, target height from peaks or low projected from the breakout. Then 3, let's talk about the triangle. Triangles are continuation pattern, although they can also act as reversal in some cases. Types of triangles. Number 1, we have ascending triangles or bullish continuation triangle, which are the flat resistance and rising support, which is also breakouts usually occurs upward. Then the descending triangle or bearish continuation triangle. How do you identify them? You identify them by flat support and falling resistance. Breakout usually occurs downward. Then we have symmetrical triangle or continuation on breakout unknown, converging trend line, price consolidating before breakout in either direction. Then trading strategy for trading triangle. Number 1, wait for breakout with high volume. That is number 1. Number 2, place stop loss inside the triangle. Number 3, target equals to base of triangle projected in the breakout direction. Number 4, flags. Flags are short-term continuation pattern that occurs after a sharp price move. The flag pole. And here is the structure. Flag pole, sharp upward or downward movement. Flag, a small consolidation channel typically against the trend of the pole. Duration is usually 1 to 3 weeks of a daily candle or a daily chart. What are the trading strategy of flags? Because when I mention them, I give you the trading strategy. Number 1, enter in the direction of the previous trend after price breakout of the flag. Number 2, stop loss slightly beyond the opposite edge of the flag. Number 3, target length of flag pole projected from breakout. Number 5, wedges. Wedges are sloping pattern that can signal both reversal and continuation. Are you getting my point right now? Types of wedges. Number 1, we have rising wedge or bearish reversal. What does they do? Price makes higher high and higher low but narrows. Also, breakout usually downward. Then we have falling wedge or bullish reversal. Mainly, price makes lower high or lower lows, narrowing breakout usually upward. Then, what are the trading strategy of falling wedge? Number 1, enter trade on breakout direction. 2, stop loss beyond wedge or high low. Number 3, targets measure height of the wedge and projection on the yield. So now I will be telling you tips or key tips for trading sharp pattern. Understand? I'll be telling you key tips for trading sharp pattern. Let's continue. So guys, let's continue from where we stop. Welcome back again. Let's continue from where we stop, which is key tips for trading sharp patterns. Now I'm telling you the key tips for trading sharp pattern. Understand? Number 1, wait for confirmation. Number 1, wait for confirmation. Don't trade before breakout. Number 2, use volume as signals. Higher volume confirms pattern validity. Number 3, combine other technical indicators. Example, RSI, MACD, or moving average can reduce false signals. Number 4, trade higher time frame. Patterns are more reliable on 1 hour, 4 hour, daily, or weekly chart. Number 5, use proper risk management or stop loss and position sizing are crucial. So make use of proper risk management, stop loss, and proper position sizing. Let's continue. Strengths of sharp patterns. Visuals and easy to understand. Applicable across all markets: forex, stock, commodities, and crypto. You can also indicate potential reversals and continuations. Also work in combination with trend line, support or resistance, and also indicators. Now let's go ahead to limitation of sharp pattern. Number 1, not 100% reliable. False breakout occurs. Number 2, requires experience to identify correctly. Number 3, can fail during high volatility or news events. Number 4, patterns may appear distorted on small time frame. In conclusion, sharp patterns like head and shoulder, double top on bottom, triangle, flags, and wedges are essential tools for traders. They provide insight into market psychology, help anticipate price move, and can improve the timing of entries and exits. By combining sharp patterns with support and resistance, trend line, and technical indicators, traders can increase their probability of success and manage risk management. Let's continue. Candlestick patterns, a complete guide for forex and stock traders. In technical analysis, candlestick patterns are among the most powerful tools for understanding market psychology and predicting price movement. By reading candlestick formation, traders can identify price trend reversal, continuation, and potential breakout points. This guide will help you explain the most popular candlestick pattern, including doji, engulfing, hammer, and shooting star, and how to use them in real trading. Then you'll be asking yourself, what are candlestick patterns? A candlestick represents the price movement of an asset over a specific time frame. Example, 1 minute, 1 hour, and 1 day. Each candlestick shows the open, which is the price at the start of the period, the high, which is the highest price during the period, the low, which is the lowest price during the period, and the close, which is the price at the end of the period. Candlestick patterns are formed when one or more candlesticks create recognizable formation reflecting market sentiment and potential reversals. Then you'll be asking yourself, why candlestick patterns are important? Candlestick patterns are popular because they reveal market psychology, that is buyers versus seller strength. Number 2, identify trend reversal early. It helps in identifying trend reversal early. Number 3, it highlights support and resistance zone. Number 4, it provides high probability trade setup. And also number 5, it works across all markets from forex, stocks, crypto, and commodities. Now let's continue with major candlestick patterns. What are the major candlestick patterns? Number 1, we have doji. Then the appearance, how does it appear? The open and close prices are nearly the same, forming a small or non-existent body with long wicks, meaning that market indecision, neither buyers nor sellers have control. Number 1, types of doji. Number 1, you have standard doji, which signals indecision, often a reversal warning. Number 2, long leg doji, which shows extreme volatility and indecision. Number 3, we have dragonfly doji, which is bullish reversal potential. Then we have gravestone doji, which is bearish reversal potential. Then the trading tips are: look for doji near support or resistance, or after strong trend for reversal signal. After everything, I'll be showing you the pictures of each of these candle later in this video. I'll get to my point. Let's continue. But let me first of all read the of them out for you and explain things for you before we show you the pictures. Number 2, engulfing pattern. How does it appear? One candlestick completely engulf the previous candlestick body. And also, what are the types of engulfing pattern, candlestick pattern? We have the bullish engulfing, which is small bearish candle followed by a larger bullish candle, signal trend reversal upward. Then bearish engulfing, which signal small bullish candle followed by a larger bearish candle, signals trend reversal downtrend. Then, what are the trading tips? Confirmation with volume or following candlestick improves accuracy. Then number 3, hammer. The hammer candlestick pattern. How does it appear? Small body at the top, long lower wick appears after that downtrend, meaning buyers are stepping in, potential bullish reversal. Variation. We have the inverted hammer, which is small body at the bottom, long upper wick, signal potential reversal after a downtrend. Then the trading tips: wait for confirmation with a bullish candle after the hammer before entering. Number 4, you have the shooting stars. Appearance, how does it appear? Small body at the bottom, longer upper wick appears after an uptrend, meaning sellers are taking control, potential bearish reversal. Trading tips: use it near resistance level and confirm with a following bearish candle. Number 5, morning stars and evening star. Morning star, which is bullish reversal, occurs after a downtrend. First candle, which is large bearish, and also second candle, small body doji or spinning top. Then the third candle, which is large bullish candle, closing above the midpoint of the first. Then under morning and evening star candle, let me show you the evening star candle, which is the bearish reversal. They occur after an uptrend. First candle shows large bullish, second candle small bodied, and third candle large bearish candle closing below the midpoint of the first. Trading tips: very reliable reversal signal, especially on higher time frame. Number 6, spinning top. Appearance is small body with long upper and lower wicks, meaning market indecision, trend may pause or reverse. Trading tips: combine with support or resistance for stronger signal. Number 7, other notable patterns are harima, which is small body inside the previous large body, reversal indicator. Piercing line, which is bullish reversal during a downtrend, and dark cloud cover, which is bearish reversal during an uptrend. Let's continue. How to trade candlestick pattern. Number 1, identify the pattern. Recognize the candlestick pattern and ensure it occurs in the right context, trend or near support and resistance. Number 2, confirm the signal. Use additional confirmation like volume spike, RSI divergence, or trend line breaks. Number 3, entry and stop loss. Enter after pattern confirmation, then stop loss below bullish reversal pattern or above bearish reversal pattern. Number 4, target. Use support and resistance or support and resistance, previous swing high or low, or risk to reward ratio for exit. Tips for using candlestick pattern effectively. Number 1, higher time frame are more reliable. Daily or 4-hour charts can give stronger signal than 5 minutes charts. Number 2, combine with trend line and support and resistance, improves accuracy and reduce false signals. Number 3, practice on a demo account. Gain confidence before trading with real money. Number 4, don't trade every pattern. Wait for strong confirmation to avoid overtrading. Strength of candlestick pattern: easy to read and visualize market sentiment. Provide early reversal signals, useful across all financial markets. And also work with other technical tools for stronger analysis. What are limitations of candlestick pattern? Number 1, not 100% accurate. False signals also occurs. Patterns may appear distorted on lower time frame. Market news or volatility can invalidate patterns, and also it requires experience to interpret correctly. Then, in conclusion of this candlestick pattern like doji, engulfing, hammer, shooting star, and others are powerful tools for traders to understand market sentiment and predict potential price movement. When combined with trend lines, support and resistance, and other technical indicators, they form the backbone of price action trading strategies. Mastering candlestick patterns give you the ability to read the market like a professional and make more informed trading decisions with confidence. Let's go head over to another topic, which is Fibonacci retracement and extension, a complete guide for traders. In forex and technical trading, understanding Fibonacci retracement and extension can give traders a powerful edge. Tools help you identify potential support and resistance level, trend reversal point, and price target. Based on a natural mathematical sequence, Fibonacci levels are widely used by professional traders across forex, stock, commodities, and crypto markets. So in this guide, we explain how Fibonacci retracement and extension work, how to use them, and strategies to incorporate them in your trading plan. Let's continue. What are Fibonacci retracement? Fibonacci retracement is a tool to predict potential level where a price correction or pullback may occur within a trend. The mostly common use Fibonacci retracement level are 23.6, 38.2, 50%, not an official Fibonacci number but widely used, 61.8%, and 78.6. I get my point right now. Then you'll be asking yourself, how does Fibonacci retracement works? Number 1, identify the start, which is low, and the end, which is high of the price for an uptrend. Then draw the retracement tools from the start to the end of the trend. Then number 3, the level indicate potential support where the price may reverse upward after a pullback. In a downtrend, Fibonacci retracement level act as a resistance where price may reverse downward after a rally. Then what are Fibonacci extensions? Fibonacci extension help traders determine potential price targets beyond the current trend. They are commonly used to set price targets, identify potential breakout zones, and also predict trend continuation. Then what are the common Fibonacci extension levels? Number 1, 61.8, 100%, 161.8, 261.8, and 423.6%. Then you'll be asking yourself, how does Fibonacci extension works? Number 1, you need to identify the start and the end of your trend like retracement. Number 2, you need to draw the extension tool from the start to the end of the trend, then back to the retracement level. Number 3, the level indicates potential areas where the trend may continue or reverse. Then why traders use Fibonacci tools. Fibonacci retracement and extension are widely used because 1. They identify high probability support and resistance level. Number 2. They help time entries and exits. So they help in timing the entry and exit level. Number 2. They help to improve risk to reward ratio. Number 4. They works in trending and ranging markets. Then, when combined well with other indicators like trend line, moving average, and RSI, so they work well when you combine them with trend line, moving average, or RSI. Are you getting my point right now? Then let's continue. How to trade using Fibonacci retracement. So how to trade using Fibonacci retracement. Number 1, trend line pullback strategy. What you need to know when using trend line pullback strategy when trading Fibonacci retracement. Number 1, identify a strong uptrend or downtrend. Number 2, draw Fibonacci retracement from the low to high, uptrend, or high to low, which is downtrend. Number 3, wait for price to pull back to a key level of 38.2%, 50%, or 61.8%. Then number 4, enter the trade in the direction of the trend. Then number 5, place stop loss slightly beyond the next level. Number 2, confluence strategy. You need to combine Fibonacci retracement level with your previous support and resistance, your trend line, and the moving average. Entry near overlapping level increases the probability of success. Then you need to ask yourself how to trade using Fibonacci extension. Number 1, trend continuation strategy. After a retracement, draw extension level to identify where the next trend target may be. Number 2, use levels like 161.8 on 261.8 to take profits. Number 3, combine with candlestick pattern or momentum indicator for confirmation. Number 2, breakout target. If price breaks a significant resistance or support, Fibonacci extension can act as target zones for the breakout. Then let's continue. What are tips for using Fibonacci tools effectively? So you need to know the tips for using Fibonacci tools effectively. Number 1, use high time frame. Daily and 4-hour charts provide more reliable levels. Number 2, combine with trend line and support and resistance. Avoid trading Fibonacci level in isolation. Number 3, look for confirmation like candlestick pattern, volume, or RSI improves accuracy. Number 4, practice patience. Wait for price to reach the level and show reversal signals. Number 5, adjust risk to reward ratio. Fibonacci levels often align with optimal entry and exit points. What are common mistakes traders make when using Fibonacci? Number 1, using Fibonacci level without context. These are the number 1 common mistake traders make. Using Fibonacci level without context. Number 2, ignoring the overall trend. Number 3, trading every retracement without confirmation. Number 4, relying solely on Fibonacci without additional analysis. Number 5, using Fibonacci on volatile news driving charts. So some traders are making use of Fibonacci on volatile news driven chart. Don't try it. Then let's talk about the strengths of Fibonacci retracement and extension. What are their strengths? Number 1, they help identify high probability entry and exit. Number 2, they helps across all market and time frames. Number 3, enhances trading strategy and risk management. Number 4, provides visuals clarity for price targets. Then what are the limitations of Fibonacci retracement and extension? Number 1, not foolproof. Price can break level unexpectedly. Number 2, may fail during news event or extreme volatility. Number 3, requires combination with other tools for higher accuracy. Number 4, overuse can lead to confusion and analysis paralysis. Then, in conclusion of this Fibonacci retracement and extension topic, these are essential for any serious trader. They provide a clear level for entries, exits, and profit taking while reflecting market psychology. When combined with trend line, support and resistance, candlestick pattern, and indicators, Fibonacci 2 can significantly improve your trading strategy, timing, and risk management. Mastering these tools allow traders to read the market like a professional, anticipate potential reversal, and set realistic targets for profit. So these are the conclusion. So you need this Fibonacci retracement and extension. They are a very essential tools for any serious trader. So if you're a serious trader, this Fibonacci retracement and extension tool is very important for you. So when you go to your when you go to your trading view and go to indicator, search for Fibonacci retracement and Fibonacci extension. Follow these guidelines that I teach you. Make use of them. They will help you in providing a clear level for your entries, for your exits, and for your profit taking. Are you getting my point right now? Let's continue with the next topic, which is the moving average, the ultimate guide to SMA and EMA for traders. In the world of technical analysis, moving average are among the most popular reliable indicators, whether you are trading forex, stock, cryptocurrencies, or commodities. Moving averages help traders identify trend, spot entry and exit points, and reduce market noise. In this guide, we will cover the two main types of moving average, which is simple moving average and exponential moving average, explaining how they work, how to use them, and trading strategies that maximize their effectiveness. I get my point right now. Let's continue. You ask yourself, what are moving average? A moving average is a technical indicator that smooths out price data by calculating the average price over a specific period. Moving averages help traders to identify the direction of the trend, determine dynamic support and resistance, and also filter out market noise in a volatile market, and also generate entry and exit signals. Moving averages are lagging indicators, meaning that they are based on past price data. However, their simplicity and reliability make them invaluable for trend following strategies. Then number one, we were talking about simple moving average, which is SMA. What is simple moving average? It simply means the simple moving average SMA calculates the average of closing prices over a specific number of period. The formula is this: the simple moving average is equals to P over 1 plus P over 2 plus P over N, where P and N is the closing price of each period and N is the number of the period. Key features of simple moving average. Number one, smooth price data over a defined period, react slowly to sudden price changes, and better for identifying long-term trend. Common use of a simple moving average. Number one, trend identification. Price above simple moving average, uptrend. Price below simple moving average, downtrend. Number two, support and resistance. Simple moving average can act as a dynamic support or resistance line. Number three, crossovers. Golden cross, short-term simple moving average crosses over the long-term simple moving average, which gives you bullish signals. While there's cross, which means short-term simple moving average crosses below long-term simple moving average, which is bearish signals. Number two, exponential moving average, which is EMA. What are exponential moving average? The exponential moving average gives more weight to recent prices, making it more responsive to recent market movement than simple moving average. And the formula is EMA equals to price T over times K plus EME over T minus 1 times 1 minus K, where the K is a fraction 2 and the number plus 1, and N is the number of the period. And then what are the key features of exponential moving average? The key features of exponential moving average are: number one, reacts faster to recent market price changes. Number 2, better suited for short-term trading. And 3, highlight trend reversal more quickly than simple moving average. Common uses of exponential moving average. Number 1, trend confirmation. Exponential moving average slope indicates trend. Price above exponential moving average, bullish trend. Price below exponential moving average, bearish trend. Number 2, support and resistance. Exponential moving average can act as a dynamic support or resistance, especially in trending market. Number 3, crossover. Fast exponential moving average crossing above the slow exponential moving average equals to buy signals. And fast exponential moving average crossing below the slow exponential moving average equals to sell signals. Now let's talk about the popular moving average period. We have the short term, which are 5, 10, and 20 period. They are mainly quick for trend signals. Then we have the medium term moving average, which is the 50 and 100 period, which is mainly for trend confirmation. And then we have longer term period, which is 200 period moving average, which is major trend and market structure. Then traders often combine different periods to generate crossover signals and confirmation, trend, strength, and pressure. Understand? So some traders make use of crossover signals and confirm trends. Are you getting my point right now? So trading strategies using moving average. So if you want to make use of moving average, here are your trading strategies. Number 1, trend following strategy. How to use it? Number 1, identify trend direction using SMA or EMA. Buy in uptrend, sell in downtrend. Confirm with other indicators or candlestick pattern. Number 2, moving average crossover. Short-term moving average cross long-term moving average. Trend changes signals. Example, 50 EMA crosses above 200 EMA, which is golden or dead cross. Number 3, dynamic support and resistance. Price pull back to SMA or EMA. Enter trade in the direction of the trend. Stop loss slightly below or before or above the moving average. So put your stop loss slightly below or above the moving average. Number 4, combining SMA and EMA. So if you want to combine the simple moving average and exponential moving average, use the simple moving average for long-term trend and use the exponential moving average for short-term trend. Entry occurs when short-term moving average aligns with the long-term moving average trend. Now, here are the tips for using moving average effectively. So now in this section, you need to know the tips for you to use moving average effectively. Number 1, combine with other indicators. RSI, MACD or Fibonacci retracement improve reliability. Number 2, avoid overcrowding your charts using 1 or 2 moving average for clarity. Number 3, adjust period for your trading style. Short-term traders use 10 to 15 period, while long-term traders use 50 to 200 period. Number 4, wait for confirmation. Avoid trading on crossover signals alone. Wait for candlestick confirmation or volume support. Number 5, use multiple time frame analysis. Like high time frame gives you stronger signals and reduce false trades. Now, what are the strengths of moving averages? Because moving average has strengths. 1, easy to use and understand, which is number 1. 2, it works in all markets. It works in Forex, it works in stock, it works in crypto, and it works in commodities. Number 3, highlight trend clearly. Moving average highlight trend clearly. Number 4, moving average helps with trend following strategies and risk management. Number 5, moving average can be used dynamically as support and resistance. What are the limitations of moving average? Number 1, lagging indicators may give late signals, because moving average indicators are also lagging. meaning that they may give you late signal to enter your trade. Number 2, false signals in sideways or shopping market. It may give you false signals when they are sideways or shopping markets. Number 3, not effective as a standalone tool. So you should combine them with other indicators or price action. So in conclusion, moving averages, whether it is the simple moving averages or exponential moving average, are essential tools for any trader. Whether it is simple moving average is excellent for identifying long-term trade, while exponential moving average is better for short-term trading and trend reversal. By combining both the simple moving average and exponential moving average (EMA) with trend line, candlestick pattern, Fibonacci levels, and other indicators, trader can significantly improve their entry and exit timing, manage risk effectively, and gain an edge in the market. Mastering moving average allows traders to visualize the trend, filter market noise, and make informed decisions with confidence. Are you getting me? So in general and in conclusion, the moving average, whether it is a simple moving average or exponential moving average, it gives a trader confidence, and gives a trader the ability to to visualize the trend, number one, and also gives him the ability to filter market noise, and also makes him to have informed market decision with confidence. Are you getting me? So let's continue with the next topic, which is price action trading, the ultimate guide for forex and trading stock. So price action trading, which is the ultimate guide for forex and stock traders. So in the world of trading, price action are one of the most powerful and reliable ways to analyze the market. Unlike indicators that rely on formulas, price action trading focus solely on raw price movement, candlestick pattern, and market structure to make trading decisions. In this guide, we will explain what price action trading is, why it works, key techniques, and strategies to help you trade confidently in any market. You may ask yourself, what is price action? Price action trading is a method of analyzing financial markets based on the movement of price over time. It ignores lagging indicators and relies on pattern, candlestick, and key levels to determine market direction. Traders who use price action aim to answer the following. Understand? So any trader who makes use of price action strategy aims to answer the following question. Number 1, is the market trending or ranging? Where are the key support and resistance level? Is a reversal or continuation likely? Where are optimal entry and exit points? Then ask yourself this question: why trade using price action? Ask yourself, why do you want to trade using price action? Because price action is favored by professional traders because it, 1, reflects real-time market sentiment. Number 2, it works across all markets, whether forex, stock, crypto, or commodities. Number 3, it eliminates reliance on lagging indicators. Number 4, it adapts to all time frame from 1 minute to weekly chart. And number 5, it helps to identify high probability setup. Essentially, it allows traders to read the market as it is. Yes, price action trading allows traders to read the market as it is rather than reacting to delayed signals. What are the key concepts in price action trading? Number 1, support and resistance. Support means a level where buying interest prevents price from falling further. Then resistance is a level where selling interest prevents price from rising further. Traders watch this level for potential reversal or breakout. Number 2, trend analysis. Uptrend, a series of higher high and higher low. Downtrend, a series of lower high and lower low. And range band, where price moves sideways between support and resistance. Identifying the trend is crucial for determining trend direction, trade direction. Number 3, candlestick pattern. Candlestick patterns are essential for interpreting price action. We have reversal pattern, which are hammer, shooting star, doji, and engulfing. We have continuation pattern, which are flags, pennants, rising or falling wedges. And we have indecision pattern, which are spinning tops and doji. Pattern gives insight into market psychology and potential turning points. Number 4, price action setup. Common price action setup includes pin bars, which signals rejection of price at key levels, also indicate reversal. Inside bars, consolidation within the previous bar, breaker signal are likely. Engulfing bars, which show strong buyers or sellers dominance. Number 5, market structure. Market structure refers to the highs and lows or swing points and trend line that defines a market behavior. Understanding market structure helps traders identify 1, trend continuation, trend reversal, and breakout zones. Let's move ahead to popular price action trading strategies. So there are several popular price action trading strategies, and I'm going to be listening at them for you and explaining them together for you. Number 1, support or resistance reversal. Yes, support or resistance reversal. How do you identify this? Number 1, you need to identify strong support or resistance. Number 2, you need to look for reversal candlestick pattern, which are the pin bar and engulfing. Number 3, you need to enter in the opposite of the direction of the rejection. Then number 4, you need to use stop loss beyond the support or resistance level. Number 2, we have the breakout trading. What are breakout trading? Breakout trading, price breaks a key level of support or resistance. Then enter trade in the direction of the breakout. Then confirm with volume or momentum for liability. Number 4, use stop loss just beyond the breakout level. Number 3, trend following. Identify the main trend using swing high and low. Number 2, enter trade in the direction of the trend at pullback to support, uptrend, or resistance level, which is downtrend. Combine with candlestick signals for confirmation. Then use stop loss below or above the recent swing point. Number 4, pin bar trading. Pin bar signals rejection of a price level. Number 2, enter trade in the direction of the long tails. Number 3, stop loss beyond the tails. Number 4, target based on recent highs or lows on the next support or resistance. Then the next thing you need to know is tips for successful price action trading. You need to know the tips for being a successful price action trader. Number 1, focus on higher time frame, daily, 4 hours, weekly. Gives you a chart stronger signal more than the 5 minutes or 10 minute chart. So daily and 4-hour charts give you a stronger signal more than 5 minutes and 10 minute charts. That is number 1. Number 2, use fewer trade, higher quality. Yes, use fewer trades, higher quality, meaning wait for strong setup at the key levels. Number 3, combine with market structure. Always make and consider support and resistance. Always consider trend, support, and resistance. Number 4, risk management is key. Never risk more than 1 or 2% of your account on a single trade. Number 5, avoid overcomplicating, meaning price action is simple. Adding too many indicators can confuse signals. So price action is simple. Adding too many indicators can confuse signals. What are the strengths of price action trading? 1, it works in all market and time frame. Yes, it works in all market and time frame. Number 2, it provides clean and unclustered analysis. Price action provides clean and unclustered analysis. Number 3, it reflects real market psychology. Number 4, it reduces reliance on lagging indicators. Number 5, it enhances timing on entrance and exit. Then, what are the limitations in trading the price action? Number 1, requires experience to read price pattern accurately. So it requires experience to read price pattern accurately. Number 2, can be subjective. Interpretation varies between traders. Number 3, less effective during extremely volatile news events. Number 4, patience is required. Not every setup is the trade. In this last one, patience is required. Not every setup is a trade. Then in conclusion of price action trading, price action trading is a versatile and powerful method for analyzing the market. By understanding support and resistance, candlestick patterns, and trend analysis, and market structure, traders can make high probability trading decisions without relying on lagging indicators. Mastering price action allows traders to read the market like professional, spot trend, reversal, follow the trend confidently, and improve the overall trading performance. So in all this, as a price action trader, price action trading helps you to be able to have confidence and to be able to for you to be a professional, and it will help you for you to spot trend reversal, for you to follow the trend, and also for you to improve in your overall trading career, because price is king. So you need to study price action very, very well. As I've already explained everything down to you, I'll be moving to the next episode, which is episode 5. I get my point. Right now, I'll be heading over to episode 5 because this one is the episode 4. So you will follow me as I'm moving to episode 5, and let me continue from where we stop. So follow me right now. Let's head over to episode 5. Thank you.
Hello guys, you are welcome back to my screen once again. You are welcome back to my screen once again on the episode 5 of the full Forex Trading Course. So this is the episode 5 of my full Forex Trading Course. So let's continue. So in this episode 5, I'll be teaching you how to analyze the Forex market. Are you getting my point right now? So in this episode 5, I'll be teaching you how to analyze the Forex market, which are how to analyze the currency assets. So I'm going to be teaching you how to analyze the major currency, and at the same time teach you how to analyze and trade minor currencies. So you all know in Forex we have 3 types of currencies. You have the major currencies, you have the minor currencies, and we have the exotic currencies. Understand? So in this episode 5, you'll be learning everything on how to analyze each pairs and also trade them successfully. So I'll be guiding you one after the other. So what are major currency, if I may ask? Major currency are those currency that are mostly traded in the Forex market. So, and they have more trading volume, and the people who are trading the major currency have a higher percentage. Understand? So we have major currency like Euro USD, GBP USD, and AUD USD, and so on and so forth. Then the minor currency are those currencies that doesn't have USD pairs. I get to my point. They are the minor currencies. I get to my point. So in this episode 5, as I'll be guiding you through each currency pairs, I'll be teaching you how to analyze them and how to trade them. So first of all, we will start with the Euro USD, which is one of the most traded currency pairs in the Forex market. The Euro USD. I get my point. So we will start with the Euro USD, which is one of the most traded currency pairs in the Forex market. I get my point right now. So this app I'm using right now is the MetaTrader 4. So if you don't have it, go to your Google Play Store if you are using an Android, or go to your iOS, or go to your Apple Store if you are using an iPhone. Check out or search for MetaTrader 4 or MT4. If you look for it, then download it and install it on your mobile phone. When you install it, go ahead and open a demo account
and let me guide you through how you'll be able to analyze and trade the market. So let's begin with the Euro USD. Once you click on the Euro USD, the first thing you need to click is what? Click on open chart. When you click on open chart, you will find out that there are different types of time frame. We have monthly time frame, we have weekly time frame, we have daily time frame, we have the 4-hour time frame, we have the 1-hour time frame, we have the 30 minutes time frame, we have the 15 minutes time frame, we have the 5 minutes time frame, and we have the 1 minute time frame. So it depends on the type of trader that you are. That will determine the type of trading that you want to focus on. Are you getting my point? So if you are a swing trader, or let me begin with a position trader. If you're a position trader, you know that your area of analyzing the market will be on the monthly time frame. Then your entry will be on the weekly time frame. Then if you're a swing trader, your measure of analyzing the market will be on the daily time frame. Then your entry will be on the 4-hour time frame, some on the 1-hour time frame. Then if you're a day trader, your major analysis will be on the 4 hours time frame. Then your entry will be either at the 1 hour or the 30 minutes time frame, depending whichever way you want it. Are you getting my point right now? So this is the Euro USD monthly time frame. As you can see it now, the chart you are seeing right now is the candle. All these things are the candlesticks. The green one signifies the buy, that buy signifies buys, and the red ones signify sell. So you can change it to any color of your choice, but this color, red and green, has been the general color, but that most traders, including me, are using. So whenever you see the market, whenever you see the green candle, you know that the market is in a bullish, and whenever you see the red candle, you know that the market is in a bearish. Are you getting my point? So now, if you look at this monthly time frame on the Euro USD, you find out that the overall directional movement of this market has been towards the downside. You understand? If you look it very clearly, very well, you find out that this market has been on a series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Understand? So on the long run, on the monthly time frame, if you have found out that the Euro USD has been on a downtrend on the monthly time frame for a very long period of time. So right now, since you have already gotten the bias that the monthly time frame or on the Euro USD is selling for a very long time, the next thing that we need to do is that we head over to the weekly time frame for us to confirm what it is saying. So in the weekly time frame, we found out that the market has been also in a series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Then giving us a signal that there might be a selling opportunity in this market, because if you look at the very top of this chart, you find out that there has been a candlestick rejection at this around this level. Are you getting? There has been a candlestick rejection around the 1.15737. Around this level, there has been a candlestick rejection, which is signal a potential price reversal. Are you getting my point? So after the weekly time frame, then we will be switch over the daily time frame. When you switch over the daily time frame, you find out that the market has been in a series of low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So there is a potential probability that the market is gonna sell from this point level, since there are a series of conjunction, or the series of consolidation between the high and the low, because the price is neither moving high and the price is neither moving low. So you find out that there is a series of price rejection in this very level that you are seeing. Are you getting my point? So let me draw it for you. You find out that there is a series of price rejection in this very level, in this very 1.18 level, and in this very 1.1357. So there has been a series of price rejection in this level. So all you need to do is for you to be patient and wait for price to give us a set signal, then we can enter the market. Are you getting me? But mainly what I'm teaching you is just the practical, for you to know and understand how to analyze each forex market pairs. I got me right now. So after that, what we do is this now, is that we go over to the, this is the day time frame. You go head over to the 4-hour time frame. When you head over to the 4-hour time frame, you find that the market has been in a series of lower low, lower high, lower low, lower high, lower low, lower high, and now is now forming another lower low at this very end. So it's still giving us a clear signal that the selling opportunities is eminent in the Euro USD. Are you getting my point, right? So it is showing us that the selling opportunity is eminent in this Euro USD. Then the next thing we need to do is that if you are a swing trader, then you hold over to the 1-hour time frame or some day trader. Then what we need to do right now is that in 1-hour time frame, I see that the price has been a series of higher high, low, higher low, higher low, higher low, higher low. Then it changes direction towards the downside. So what we need to do is for us to wait for the price to reverse and push a little bit to, let me say, 1.1600. Then we can sell from there. Understand? If you're a swing trader. Then if you're a day trader, you can head over to the 30 minutes. Then once you head over to the 30 minutes, all you need to do is you can see that the market has been on a downtrend on the 30 minutes, showing us a series of lower low, lower high, 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 up until this level. So what we need to do is for the next level for us to form a very lower high. Once it's formed lower high, then we can sell at the lower low. So this might be my ending point. If you're a day trader, also you can move another time frame ahead, which is the 15 minutes. If you don't like the 30 minutes time frame, you can move to the 15 minutes and look out for your entry at this very level. So now the overall directional movement of this Euro USD pair is now on side. So we'll be doing more of the selling opportunity. So we'll be looking for selling opportunity for us to sell this particular Euro USD. I got my point right now. So this is how you will be analyzing each currency pair whenever you see them on the market. I got my point. So it is called it is what we call the top-down analysis. So top-down analysis is basically analyzing an asset from the top to the down, from the higher time frame down to the lower time frame. It is called the top-down analysis. I got my point right now. So right now, let's continue to the next one, which is the next currency pair, because I'll be teaching you everything for all the major currency pair. I will analyze all of them from you in this video, and also the minor currency pair, so that you won't left out and so that you won't be confused when analyzing the market. Are you getting my point? Because I need to do everything practical for you guys. So let's head over to the next currency pair, which is the GBP USD. So for those of you who doesn't know what is GBP, GBP means Great British Pounds against the US dollar. So right now you are trading the Great British Pounds against the US dollar. So let's head over to first of all to the monthly time frame to see what monthly time frame is saying about. So what it means is that all these candles that you are seeing, that one candle forms every single month. So every month a single candle forms. Every month a single candle forms. Every month a single candle forms. So the monthly time frame holds more information than the daily time frame. So it means that throughout the whole month the GBP USD was either in a bullish or whether it's in a bearish. So the monthly time frame will give you a clue of how a currency perform in a particular month. So are you getting my point? Since it takes longer time for it to form, so it holds more information more than the weekly or the daily time frame. Are you getting my point? So right now, if you look at this overall directional movement on the GBP USD, you find out that this market has been on a downtrend for a very long time, from 2004 up until 2025. You find out that the market has been in a series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Almost as of from 2013 to 2015, the market has been on a sell, lower low, lower high, lower low. In 2019, lower high. In 2020, in 2021, lower low. In 2023, up until now, the market has been for a very long time on a downtrend. So the majority of what the GBP have been doing for a very long time is sell, but only on the monthly time frame. Then you need to go to the weekly time frame. When you click on the weekly time frame, then we find out that the market in the weekly time frame has been giving us, a buying opportunity in recently, in the sense that the market has been a series of the higher high, higher high, higher low, higher high, higher low, higher high, higher low, high high, then now retesting to form a higher low before it pushes up to the higher high. So if you see that in actual sense, the in the weekly time frame, the GBP has been forming showing signs of buying opportunities, because we won't be trading on the monthly time frame. No, rather we are analyzing and making sure that we are on the good side of the market. We are on the side of the big banks. We are on the side of hedge funds, so that we won't be against them. Are you getting my point? So since the longer time frame, which is the weekly time frame, is showing us the series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, another higher high that will form. So now let's now go over to the daily time frame for us to confirm this decision whether it is a buy. Then we go to the daily time frame. So when we go to the daily time frame, we find out that the market has been on a bullish for a quite a long for a quite time right now. So you find out very well that the market has been on a series of bullish, series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So if you look at this market now, you find out that there is a potential that the market will continue to buy at this level, since there have been a series of higher high, higher low, higher high, higher low on the daily time frame. So what we need to do is for us to go a step further to another time frame for us to give us more direction. Now, if we see the 4-hour time frame, then the 4-hour time frame has been an opposite of what the day time frame and the weekly time frame is saying. The market has been on a series of lower low, lower high, lower low, lower high, lower low, lower high. So as you can see now, it seems that the price is about to, is forming, is rejecting around this 1.31300 level. So making it more, making it more valuable and versatile, that the price is likely to go towards the upside. But for us to have more confirmation, before putting our buy opportunity, or before looking at our buy opportunity, we will go a little bit step further on a 1 hour time frame. So if you look at the 1 hour time frame, you see find out that the market has been in a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. Then a little bit of rejection and a little bit of consolidation between the support and resistance level. So if you look at this thing now, it's showing that the market is neither moving upward or the market is neither moving downward. So what we need to do is to wait patiently for the market to give us a bullish engulfing pattern of a buying opportunity for us to buy from the next level. Are you getting my point right now? So that is mainly for the swing traders. But if you are a day trader, maybe you can go a step ahead further to the 30-minute time frame. Maybe you can trade the counter trend. By counter trend, I mean you can trade the opposite of the buy, which is sell. But you need to be experienced before you can be able to trade the opposite of the trend, which is the counter trend. So if you don't have experience, always follow the trend, always know the direction of the trend. But I'll always tell you this: if you don't understand the direction of where the market is going to, or if you don't understand the direction of the market, all you need to do is to just step out of that currency pair and move to another currency. I get my point right now. So after looking at the 30 minutes right now, you see that the 30 minutes the 30 minutes time frame, the price is in a congestion. The price is neither up, or the price is neither down. I get my point right now. So you need to wait patiently for the price to go very well. Understand? So let's head over to the 15 minutes time frame for more clarity. For those of you who are into the trading, or scalpers, you can head over to the 15 minutes time frame, and you can see the price has been dangling between the up and down, between the buyers and seller. So that is why the 15 minutes time frame, there is a whole lot of noise in the 15 minutes time frame, and a whole lot of candlestick spikes in the 15 minutes time frame. So that is why I always stick to the 1 hour time frame. So my analysis end in 1 hour time frame. Anything aside from 1 hour time frame, I don't trade it. but you can move a step further, or if you want to have more refined entry in your trading strategy. Are you getting my point right now? So right now, let's head over to the next currency pair, which is the USD JPY. So the USD JPY is what we call the United States dollar against the Japanese yen. Are you getting my point? So USD JPY is the United States dollar against the Japanese yen. So right now, if you look at the charts, you find out that on the monthly time frame, the market has been in the upward direction, meaning that the market has been buying for a long period of time. Are you getting? Are you getting the point right now? Just look at the chart right now. You find out that the market has been in an uptrend from 2011 up until 2025. If you look at this market right now, from April 1st, 2011, the market has been in a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So on a very long time, the market has been on a very long bullish trend in the US dollar Japanese yen. Are you getting my point right now? So since the market has been on a very long period of time in the monthly time frame, what are we be looking for? You'll be having at the back of your mind that the market is showing a bullish opportunity or a buy signals. So we'll be looking for a buy signal in this type of pair. Are you getting my point? But before we look for a buy signal, let us confirm whether what we see in the monthly time frame is it the same as the weekly time frame and the daily time frame. Then let's head over to the weekly time frame. If you head over to the weekly time frame, we will find that the market has been also in a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, and higher high. So you find that even in the weekly time frame, the market has been on a series of higher high, higher low, higher high, higher low, higher high, higher low, higher low. So you need to also understand that this market is showing us a buying opportunity. You're getting my point. So for the fact that it's showing us opportunity, let us now move ahead further to the next time frame, which is the daily time frame. If we move to the daily time frame, we still see the opportunity that the market has been on a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher high. So what you need to do is that we have to be patient for the price to form a higher low. Then we can buy at the higher high. Are you getting my point? So that is why you need to be patient to wait for the price to come down a little bit higher low before you can buy at the next high. I got my point. Because the market is going up trend doesn't mean that you should buy immediately. No, you have to wait patiently for the market to form a higher low. Then before you can buy in the next trend that is moving to the higher high and ride the wave of that market. This is the day time frame. Then let's move a step further on the next time frame, which is the 4-hour time frame. If you look at the 4-hour time frame, we still see that the market has been on a long uptrend. You can see it series of higher high, higher low, 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 higher high. So this market has been in a series of uptrend for a quite longer amount of time right now. So it is still giving us a clear sign of buying opportunity. That is why it is good for you to follow the trend, for you to trade with the trend. Don't go against the trend. So right now you are seeing that on the overall analysis on this USD JPY, the market has been on a uptrend, has been buying. Are you getting my point right now? So you need to know this and know it very well. Right now, let's head over to the next time frame, which is the 1 hour. As you can see, it even in the 1 hour, the market is still showing us a series of high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. Even on a long period of time, the market has been showing us a buy signals. What it means that you wait for the market to form a higher low, then you buy from the higher high. As for me, I will only wait and end my trade in the as for me, I will only wait and end my trade in the 1 hour time frame. Are you getting my point right now? I will only end and end my trade in the 1 hour time frame. Are you getting my point? Because I'm a swing trader. So if I don't want to enter my trade like that, maybe I can go a step further on the 30 minutes time frame. If I go a step further on the 30 minutes time frame, I can be able to also analyze the market by looking at the series of higher low, higher low, higher low, still in the uptrend direction. So what I will do right now is for me to wait for the market to go higher low, then I will buy from there. I got in my point. So this is basically for the USD JPY, because this and what moves this currency pair is the Bank of Japan and also the Federal Reserve, which is the United States. So that means you are trading the US dollar against the Japanese yen. I've gotten my point right now. So let's continue with the next candlestick, with the next currency pair, which is USD CAD. It means United States dollar against the Canadian dollar. So you are trading the United States dollar against the Canadian dollar. I've gotten my point right now. So what it means is that for you to understand the pair of the United States dollar against Canadian dollar, you first of all move towards the higher time frame. Like I always tell you, if you want to analyze the market, first of all move to the higher time frame. Start from the monthly. If you start from the monthly, you will find out that in the overall directional movement of this market, the market has been on a series of buying opportunity. If you look at it very, very clearly, the market has been on a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So in the overall directional movement of this USD Canadian dollar has been on the buying opportunity. So you'll be looking for more buying opportunity in this market. Are you getting my point now? You'll be looking for more buying opportunity in this market. So you need to buy more. Are you getting my point? So you need to buy more in this market. So let's head over to the next time frame, which is the weekly time frame. If you look at the weekly time frame, it is still the same opportunity. The market has been in a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So you need to be patient and wait for the market to pull down a little bit. Then you buy at higher high. I got to my point. So you have to wait for the market to pull down a little bit. Then you buy at the higher at the low that will continue the movement of the new high. I got to my point right now. So let's head over to the next time frame, which is the daily time frame. When we move to the daily time frame, you find out that the market had been moving in the series of lower low, lower high, lower low, lower high, lower low. At some point, it changes direction and starts moving in a series of higher low, higher high, higher low, higher high, higher low, higher low, which also confirms that the market is now on an uptrend. So what we need to do is for us to be patient, for the market to form a higher low that will lead us to form a new high. Then you can buy from there, then put our stop loss and our take profit. I'm getting my point right now. So right now, let's head over to the 4-hour time frame and then the 1 hour time frame. So if we move towards the 4-hour time frame, you can see the market has been in a series of for the first of all series of from the uptrend. The market has been on an uptrend, form a consolidation, then break above the support level, which forms break above the support level and forms a new high, come down again, forms a new higher low. So what we need to do right now is for us to be patient. For swing traders, you need to be patient, so that the market can give us a clear signal that the market is about to buy again, for it to follow the major directional movement of the high time frame, which is the weekly and the daily, and also the monthly. Then we can buy from here. Are you getting my point? Then if you don't want to buy from in the 4-hour time market, you can switch over to the 1 hour time frame. If you switch over to the 1 hour time frame, we can wait for the market. If you can see, the market has been on on a downtrend, on a series of lower low, lower low, lower high, lower low, lower high, lower low, lower high. Later on, it changes direction to the series of higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. Break below the the support area. This is the support area. Then forms another new resistance. Then now break down. Now it's now moving, and it's now moving towards the opposite direction, which is towards the upside. So in a more sense, it shows that this 1 hour time frame is showing a sign that the market is about to go buy. So what you need to do is for you to be patient and exercise patience for the market to give us a clear signal. So you need to form by a signal, you need to have our confluence, whether it's a candlestick pattern, like let me say bullish engulfing, or hammer. So it depending on the kind of candlestick pattern that you need for us to buy this very currency pair from the 1 hour time frame. Then if you're a day trader, you can head over to the 30 minutes time frame and still analyze the same thing. I got my point right now. So let's continue to the next currency pair, because I will be analyzing all the major currency pairs for you. I got my point right now. So let's head over to the next currency pair, which is the USD Swiss franc. So USD Swiss francs. So if I see the USD Swiss francs, let's head over to the monthly time frame. So this is the currency pair that you're trading the US dollar against the Switzerland currency money. So as you can see right now, the market has been on a series of lower low for a long on a series of sell for a long time. If I see very well, the series have been a series of lower low, lower high, lower low, lower high, lower low. A little bit of consolidation, then forms another low, forms lower low, forms lower high, forms lower low, lower high, lower low, lower high, lower low, lower high, lower low. So this market right now is showing us a clear sell signal. Are you getting my point right now? This market right now, the monthly time frame is showing us a clear sell signal, but we won't sell at the monthly time frame. All we need to do is to move a step further, which is the weekly time frame. Let's confirm what the market is telling us. So if you see the weekly time frame, you see right now the market has been in overall downtrend, confirming what the day time frame confirming what the monthly time frame has been doing. Are you seeing it? Series of lower low, lower high, 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 and lower low. As you can see it right now, the market has been in a downtrend for a very long time, which confirms what the monthly time frame is saying, that the market is a downtrend, which means we are looking for a selling opportunity in this market. So there's no business for you looking for buying opportunity. No, we'll be looking for a selling opportunity. Now let's head over to the next time frame, which is the day time frame. Let us confirm what we have been saying. As you can see it again, the market has been on a series of lower low, lower high, lower low, lower high. So if you zoom your chart, you find out that the market has been very low. The market has been selling for a long period of time on the USD Swiss francs. So there is no business for you looking for buying opportunity. No, since you have seen it clearly that the market is selling, so there's no need of you buying the market, because you only trade what you see the market, not what you feel. So right now you don't even need to buy a robot for the robot to dictate what is happening in the market. The market has been on a selling opportunity overall. Are you getting me right now? So we will be looking for selling signals. And what are selling signals? We'll be looking for evening candle, or we'll be looking for bearish engulfing candle. Understand? But let's head over to the next time frame, which is the 4 hour time frame, for us to confirm more. If we move to the 4 hour time frame, we find out what I'm saying. The market has been a series of lower low, lower high, lower low. Have you seen how the market we were able to crash down? Now is now moving back to lower high. Then what we need to do is for us to be patient for the market to show us a signal, something like bearish engulfing pattern or the evening star. Then we can sell from there. Are you getting me? Because the market moves zone by zone, and the market moves in waves, and it moves in zone by zone. So right now you need to wait for it to give us a clear signal before we can sell this pair, or else we can move down to the to the 1 hour time frame. If we move to the 1 hour time frame, we will now see it again that the market is showing us a clear sell signal. If you can see it, the overall directional movement of this pair is on a sell. Can you see it very well now? The market has been selling series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, and now it's moving a lower. It's not forming a lower high. that is now giving us a clear signal that the market will be potentially sell from this level. Are you seeing it now? So this thing, have already give us a clear signal that the market is about to sell. So there's no need for you trying to buy this market. No, look out for selling opportunity. So that is why you need to analyze the market from the higher time frame down to the lower time frame for it to give you a clear understanding of what is happening in the market in general. So right now, if you don't want to enter your trade in the 1 hour time frame, you can move a step further towards the 30 minutes. So if you move towards the 30 minutes, you find out what is happening in this market now. The market is moving towards the chase of lower low, lower high, lower low, lower high, lower low, lower high, lower low, and now start moving towards the upside. Higher high, higher low, higher high, higher low, high high, higher low, higher high, higher low, higher high. But once you are seeing the 30 minutes time frame now, 30 minutes time frame now, what will make some traders will lose money in this market? The moment they buy from this level now, the market will start selling, because the market will always respect the bigger time frame. If there's anything you take away from this section, always know that the market will always follow the bigger picture. Always know that the market will always respect the bigger picture. The market will always respect the bigger time frame, and also the bigger time frame will always win. So once you are seeing this sign in this 30 minutes time frame, you'll be thinking, yes, oh, the market is buying. No, the moment you start buying right now, the market will start selling. That time you will be saying, oh, the market is rigged against you. No, it's because you did not analyze the market properly from the higher time frame before coming down to the lower time frame. Have you seen it now? You have seen it clearly that the market is in uptrend, but right now it is forming a series of higher high, higher low, higher high that will now reverse to form a new low, in the sense that you start forming a series of lower low, lower high, lower low again. The market will start crashing from there. So that is why it's very, very important for you to start analyzing the market from the lower time frame. For you to start analyzing the market from the higher time frame, beginning from the monthly to the weekly to the daily to the 4 hours to the 1 hour and the 30 minutes. The least that I will analyze is the 1 hour time frame. I get my point, because from 30 minutes time frame up until 1 minute time frame, there are a whole lot of noise in the market. I get my point. There are too much candlestick and there are too much spikes in the small time frame. I get my point right now. So right now, let's head over to the next currency pairs, which is the NZD US dollar, New Zealand dollar USD. So what is New Zealand dollar? New Zealand dollar is a currency that is being used by New Zealand, and USD is a currency that is being used by US dollar. So now you are analyzing the pair by trading the USD, the NZD against US dollar. But before then, the first thing that you need to do is what? Head over to the monthly time frame. When you head over to the monthly time frame, you can see clearly. You don't need to buy expensive course for you to understand these things. Only this video will change your approach towards forex trading. Look at it. Just look at it very, very clearly. You can see this thing right. Very simple. Use your clear eye and watch it from this market from left to right. You find that this is a very clear downtrend, that the market is showing us a selling. Why? It has been in a series of lower low, lower high, 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 lower low. So in the overall movement of this market has been on a downtrend. So what does it mean? We'll be looking for selling opportunity. It's that simple. Are you getting me? Don't complicate things. You don't need to put your indicator, because as you are seeing me right now, you don't see any indicator in my chart. You don't need to complicate anything. This is a pure, clear set direction. So right now, let's move out to the next time frame, which is the weekly time frame. As we see on the weekly time frame, it still confirms what I'm saying. The market has been on a downtrend for a very long time. From 2020, the market has been on a downtrend on the weekly time frame in the New Zealand dollar USD. Look at it very well. For 2020, look at the date in the bottom of the chart. For 2020, the market has been on the downtrend, series of lower low, lower high, lower low, lower high, lower low, lower high, lower low. So the market has been selling for over 5 years right now. So why are you looking for buying opportunity, whereas the overall market direction is telling you selling opportunity? So you'll be looking for more selling opportunity in this market. Are you getting my point right now? I will always tell you this: don't trade against the trend. No, follow the trend, because right now the market is showing the overall directional movement at the sell. This is what the New Zealand dollar, the weekly time frame, is telling you right now. Let's head over to the daily time frame for us to confirm it once again. If you move to the daily time frame right now, this is the daily time frame of NZUSD. This is the overall directional movement of this market. The market is still moving towards the downside. Series of lower low, lower high, 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 lower low. So it is still showing us a clear downside, a clear downtrend in the market. So we'll be looking for selling opportunity. Are you getting my point right now? So we'll be looking for selling opportunity. So that is what we'll be looking for right now. Let's head over to the 4-hour time frame. Are you getting my point right now? So if you head over to the 4-hour time frame, you can see clearly that the market is still showing us a downtrend. Are you getting me? The market is still showing us a downtrend in the market. The series of lower low, lower high, lower low, lower high, lower low. So if you can see this market very clearly, it's showing us the side. The market is still about to, is still showing us a very clear signal that the market is still selling in the 4-hour time frame. Take a look at it. The series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So the market has been on a downtrend even on the 4-hour time frame. I got my point right now. So we'll be looking for selling opportunity. So nothing like buying opportunity in this market. No, we'll be looking for selling opportunity. I got me. So in the NZDUSD, we'll be looking for selling opportunity. Then let's head over to the 1-hour time frame. If you head over to the 1-hour time frame, it's still almost the same thing. The market has been in a consolidation. It has been neither the buy or sell, but the overall directional movement have told us, which is the monthly time frame, weekly time frame, and daily time frame, and 4-hour time frame. It has told us the market is moving towards the same opportunity. So we'll be looking for selling signals. So in this 1-hour time frame, we'll be looking for selling signal. We'll be looking when the market forms a bearish engulfing pattern or an evening star, then we enter the trade. Or you can head over to the 30 minutes. If you head over to the 30 minutes, you can still find a selling opportunity in the 30 minutes. You can still see the market is moving toward the downside. So what we'll be doing is that we'll be looking for selling opportunity only. I get my point right now. So let's head over to the another time frame or another currency pair. I get my point right now. So we have finished the NZUSD. Let's head over to another currency pair, which will be AUD/USD. AUD/USD is simply the Australian dollar trading against US dollar. So let's begin from the weekly time frame. From the monthly time frame, because I love analyzing the market from the tops down to the bottom. Are you getting me? Right now, this is the monthly time frame. If you see the monthly time frame right now, the overall directional movement of the market is on the sell downside. Just take a close at this chart now. The market is literally going towards the downside without even you having a microscope. Just look at it clearly. The market is clearly moving towards the downside. Series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So the market has been selling for years in AUD/USD monthly time frame. What you need to do, since you have seen this is a clear selling signal, go to the weekly time frame for you to confirm this thing. Then the weekly time frame still confirm the same thing. It is moving towards the downside. Lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. So if you want to form lower high and forms again lower low, so it's showing us a clear signal that the market is selling, has been selling, and we don't have any time to continue to sell, because it is likely to sell more. So what we need to do it right now is for us to move to the daily time frame. If we move to the daily time frame, the market has changed direction. Now it forms a series of higher high, higher low, higher high, higher low. But somewhere around this level, it begins to consolidate. The market is neither moving higher high nor higher low. The market is stuck between the support and resistance. So what we need to do to wait is that we need to wait patiently for this market to break down. If we break down, yes, we know that this thing is a sell opportunity, but if it breaks towards the upside, no, we don't buy it. What we need to do is, if it breaks to the upside, we wait for the market to give us a retest signal. If it retests, then it can go towards, because sometimes what we do is that it will trigger buyers to buy this market. Then the market will move towards the upside. The moment people start buying the upside, then it will crash. Now people will start selling. So what we need to do is for us to wait for the market to break down this level, or you need to wait for the market to break towards the upside, then form a retest and break towards the downside. Are you getting me out? Because that is what we call a stop loss hunt. So stop loss hunt is where the majority of traders put their stop loss, and the big market makers always trigger those stop loss so that they can use it to, you know, to fill in their orders. Are you getting my point right now? So let's head over to the 4-hour time frame. If you head over to the 4-hour time frame, we see that the market is also on a downtrend. Are you getting me? The market is also on a downtrend. Series of lower low, lower high, lower low, lower high, lower low. Are you getting me? So the market is almost generally in downtrend. So we'll be looking for selling opportunity in this market. So anything that will make you to buy this market, don't buy it. Follow the trend, which is the selling opportunity in this AUD USD. After that, we head over to the 1 hour time frame. If you head over to the 1 hour time frame, let's see it clearly right now. The market is still heading towards the downside. See the series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So if you can see it clearly right now, the market is heading towards the downside. What we need to do is to look out for selling opportunity only. You'll be only looking out for selling opportunity, nothing more, nothing less. Anything less than selling opportunity is not for us in this market. I get my point right now. So we'll be looking for selling opportunities only on this market. We'll be looking at for selling opportunity. We will be continue selling this market. No buying opportunity. No, we'll be looking for selling opportunity. I get my point right now. So let's go head over to the 30 minutes time frame, which is my final time frame. If you got 30 minutes time frame, still the same thing that confirms what the monthly time frame, the weekly time frame, the daily time frame has been saying. Even the 4-hour time frame has been saying. Still 30 minutes time frame is still showing us a clear downside or a clear downtrend. Series of lower low, lower high, 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 lower low, lower high. So the market has been showing us a clear signal of buying, or sorry, of selling opportunity. So the market has been selling for a long period of time. So there's no need for you buying this market. No, look out for selling opportunity. Like I always say, always follow the trend. Don't go against the trend. Are you getting my point? Always follow the trend. Don't go against the trend. Make sure you follow the trend. Are you getting my point? Make sure you follow the trend. Are you getting my point right now? So let's head over to the next currency pair. After the AUD USD, we have the AUD NZD. I get my point. But right now we are entering into the minor currency pair. Right now we are in minor currency pair. So I have finished analyzing the major currency pairs, because those currency pairs that I first analyzed are the major currency pairs, which are the most traded currency in the forex market. Are you getting me? They are the most traded currency in the forex market, and this is what you'll be trading as a beginner. So if you're a beginner starting out new in the forex market, you'll be trading the major currency pairs. So for you to gather experience and for you to gather confidence as a trader, so you need to focus on the major currency pairs. Are you getting me? So leave the minor currency pairs. But you know, if you want to trade the minor currency pair, I will also be analyzing the minor currency pairs for you. You understand? But as a beginner who is starting out in the forex market, you need to master the major currency pairs. I'm getting my point right now. So let's continue. Let's continue with the minor currency pair. Minor currency pair are those currency pairs, you know, that is being traded, but they don't have the US dollars attached to them. So minor currency pair doesn't have the USD attached to them, while the major currency pair have the US dollar currency pair attached to them. As you can see in the right side of this my screen, that the major currency pair that I've already explained, the Euro USD, the GBP USD, the USD JPY, USD Canadian dollar, the USD chef, NZD USD, and AUD USD. These are the major currency pairs which I've already analyzed and explained for you. So right now I will be analyzing the minor currency pairs, which are the AUD, NZD, AUD, Canadian dollar, AUD Swiss francs, AUD Euro JPY, Euro GBP, GBP JPY, Euro AUD, AUD JPY, GBP Swiss francs, NZD JPY, Euro NZD, Canadian dollar Swiss francs, Canadian dollar JPY, Euro Swiss francs, Euro Canadian dollar Swiss francs JPY, and also I'll be analyzing the commodity for you, which is gold XAUUSD. So let's continue from where we stop. Which should be my first the first minor currency pair, which is AUD NZD. I got my point. So in AUD NZD, let's continue from the bigger time frame, which is the monthly time frame. Let me explain. In this analyzing the market, you can use it to analyze any market. You can use it to analyze the forex. You can use it to analyze the stock. You can also use it to analyze the crypto market. Once it is a tradable asset, you can use these things to analyze it very, very well. Understand? So let's continue. On the monthly time frame of AUD NZD, you will find out that the market is in overall selling opportunity. Understand? If you take a look at this market very, very well, you see that this market has been selling for a very long period of time. So right now, this is a selling market opportunity. Since it is selling, we'll be looking for a selling opportunity. Right now, it is in a downtrend, because what makes it a downtrend? It is in a series of lower low, lower high, 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 lower low, lower high. So it is in a series of downtrend for a very long period of time. Right now, let's head over to the next time frame, which is the weekly time frame. As you can see, the weekly time frame is giving us a series of lower low, then a series of long-term consolidation, because the market is neither moving towards the upside or downside. If you look at this huge candle, you know that the market has been in a series of almost the same level of the buying and selling. It is neither going toward the upside or downside. But at the tail end of this trend, you found out that the market was able to break the support. Understand? You found out the market was able to break the support and then forms a new high in this level. So giving us a clear signal that the market is likely to sell from there, because normally if you go back from here, when the market reached this level, the market was able to sell down from here. I get my point right now. So there's likelihood that the market will be also able to sell from this upward towards the downside, since it was able to break down towards the downside from here, and also there's every tendency that the market will sell up from here. So right now, let's move ahead to the daily time frame for us to confirm everything that this market is telling us. Right now, if we move towards the daily time frame, you can see the market is also giving us a series of lower low, low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. Now, but it's still giving us an inverse hammer, showing us that there is a clear opportunity, a clear sell opportunity, that is selling opportunity is eminent in this market. If you can see, there's an inverse hammer in this pair, showing us that there is potential for this market to continue to sell. I get my point. But let us head over to the 4-hour time frame for us to get more clarity and more understanding. I got me. If you head over to the 4-hour time frame, you still find out that the market did what exactly I was anticipating. It moves in a series of higher high, higher low, higher high, higher low, higher high, break above this level. Then what it do? It retested. Once it retested, it break over again. In this level of this high now, people will be dabbing in for them to buy this particular market. But what happened later on? The market reversed and starts selling towards the downside. Are you getting me now? That is why you need to always be in the right side of the market. It is good to always be in the right side of the market. Don't try to go against the trend. Are you getting me? And also, I want to tell you a tip in this video. If you don't understand a particular currency pair, if you don't understand it, if the analysis confuses you, what you need to do is for you to step out of the market and check out for another currency pair for you to analyze. Understand? Don't be confused when analyzing the market. No. Once you see that the currency pair that you are trading, you don't even understand it, what you need to do is for you to step out of that market and wait for another opportunity for you to step in. Are you getting my point right now? So right now, let's head over to the 1 hour time frame. If you head over to 1 hour time frame, you still find out clearly that the market is selling. Are you getting? See very well, the market is selling. So the market has been on a selling position. Series of lower low, lower high, lower low, lower high, lower low, lower high, lower low. So still proving to us that the overall directional movement of the market, which is the monthly time frame and weekly time frame, is selling, and the 1 hour time frame is still selling. So it shows us that it is very accuracy. It is accurate. So that is why you need to follow the trend. Right now, if you want to do this kind of pair, you'll be looking for selling opportunity, and you'll be looking for candlestick like evening star or bearish engulfing pattern for you to sell this market, because it is showing us a clear signal that the market is moving towards the downtrend. Understand? There's no two ways about it. So this is the first minor currency pair that we're analyzing. Right now, let's head over to the 30 minutes time frame. If you want to move a step further, are you getting me? So, but what I'm doing is for you to give you a clarity, for you to understand very well how this thing is being worked. Are you getting me? Then let's head over to the 30 minutes time frame. As you can see right now, what can you see? The market has been trending towards the downside. Series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. Are you seeing it? So what will we be doing in this kind of market? We'll be looking for selling opportunity. This is not a buying opportunity. No, we'll be looking for selling opportunity because the market is moving towards the downtrend. That is why to always follow the trend, because the trend is your friend. Are you getting my point right now? So let's head over to the next minor currency pairs. Understand? The next minor currency pair that you have is the AUDCAD. Understand? The AUDCAD. So the AUDCAD is the Canadian dollar, the Australian dollar against the Canadian dollar. As you can see, there is no much information in this in the AUDCAD. Then let's move to the weekly. There's not much information. The daily is not much information. So it is still loading. I will still come back to it in the next episode, in the next chapter. But let's check out for another currency pair. Let's head over to the AUD Swiss francs. If you look for the AUD Swiss francs, it's still loading. I don't know, network is disturbing. So let's check out for the next next currency pair, which is the Euro JPY. So Euro JPY is another currency pair, but it is a minor currency pair. Are you getting my point right now? So let's switch to the monthly time frame. The monthly time frame is what we have into now. The monthly time frame of Euro JPY. As you can see, the monthly time frame, just take a look at this from left to right. You can see that the overall directional movement of this asset is towards the upside, towards the uptrend, because the market has been in a series of lower low, in a series of higher high, higher low, 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 higher high. Meaning the Euro JPY monthly time frame is showing that the price is towards the uptrend, that the market is moving towards the upside. So what does it tell us? We'll be looking for buying opportunity. It's very simple. It's very simple and clear. You don't need any signal. You don't need any indicator for you to see this thing. No, this is a very clear, simple, mathematical, a very clear, simple, what your naked eye can see. The market is moving towards the upside. It is what the monumental time frame is saying. So you'll be looking for buying opportunity. Then let's head over to the weekly time frame. If you look for the weekly time frame, you can see it clearly. The market has been on a long-term buy. The market has been in a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low for a long period of time. So in this pair now, there is no need of you confusing yourself. You will be looking for buying opportunity because the market have already shown you a clear sign that it is moving towards the upside. So you can't be trading against the trend in this kind of pair. No, you'll be trading with the trend because the market is in the upside. The market is moving towards the upside. So what you need to do is that you'll be looking out for buying opportunity. I get my point. You'll be looking out for buying opportunity. So this is what we'll be doing. So we'll be looking for buying opportunity in this kind of pair. So anything less than buying opportunity, that means you are trading against the trend, and you are likely to lose your money if you go against the trend. So let's continue with the daily time frame for Euro JPY pair. Then once you are in the daily time frame, you still see the same thing, that this market is heading towards the upside. The market has been in a series of higher high, higher low, higher high, higher low, higher high, higher low. So the market has been a series of towards the uptrend, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. As you can see, it has been continuously moving towards the uptrend. So what will happen in this kind of pair? You'll be looking for buying opportunity. So lest I forget, before I forget this thing now, if you want to analyze any pair, don't analyze from the lower time frame. No, analyze from the bigger time frame. Then you place your trade in the lower time frame. Are you getting my point right now? So let's head over to the next time frame, which is the 4-hour time frame. As you can see, the 4-hour time frame of Euro JPY is still showing us a clear buy signal. Series of higher high, higher low, higher high, higher low, higher high, higher low, higher high. Are you seeing it now? It is a clear buy signal. What are we looking for this in this kind of pair? We'll be looking for buying opportunity. What are the kind of candlestick pattern we're looking for? We're looking for morning star, and we'll be looking for bullish engulfing pattern that will help us to buy this opportunity in this market. So this is a very simple and clear, straightforward trading opportunity. Are you getting me? That will guide us. Please don't you ever trade against the market. No, always follow the trend. Always follow the trend. If you can able to watch this video and understand it very well, I don't think that you can't analyze any market at all. You analyze any currency pair at all. That is why I want to analyze every currency pair for you. So once you are in this 4-hour time frame, if you want to confirm more, go to the 1-hour time frame. What can you see? The market is still clear. The market is still moved towards the upside. As you can see, the market is still towards the upside. The market is still buying series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So the market is still moving toward a series of higher high, higher low, higher high, higher low, higher high, higher low. So you don't need to doubt the market because the market is showing you a clear signal. So don't try to to go against the market. No, rather follow the footprint of the market. Are you getting me? Now let's head over to the final time frame, which is 30 minutes. If you move toward the 30 minutes, it's still showing us a clear signal the market has been on a long-term buying opportunity, even though there are short-term sales, but still the overall directional movement of this market has been towards the upside. So the overall directional market of this has been towards the upside. So we continue buying, we keep buying. So let's head over to the next currency pair, or the next minor currency pair. So let's head over to the next currency pair. I'll be analyzing Euro GBP. Understand? Euro GBP, which is the euro against the Great British Pounds. So right now, if we look closely towards the euro, the Great British Pounds, we find out that the market has been in a series of neither the market is moving towards the upside or the downside. As you can see, towards the market is neither moving towards the upside or neither towards the downside. You can see right now in this red line, you can see the market is in a ranging position. That means it is consolidating. So there's neither a buy and there is neither a sell. But if you look towards the end of this monthly time frame, you find out that the market is somehow heading towards the upside. But the overall directional movement is that the market is ranging. But somehow the market is showing a buy opportunity. But right now there is no clarity in this market. So what we need to do is for us to step a bit further to another time frame, which is the weekly time frame. As you see the weekly time frame now, it seems that the market is likely to heading towards the upside. So what you need to do is if you look at this market right now, see that the market has been consolidating somewhere or somehow from this level. The market haven't given us a clear direction, and it hasn't broken a certain level in this particular asset. So what we need to do is that if you don't understand it, let's move step ahead into another time frame, or the best thing that I always tell you is step out of the market and find another currency pair to analyze. Are you getting me? So until you get a clarity before you can jump in, let's head over to the next time frame, which is the day time frame. As you can see, the day time frame, what I've explained to you before on the moon time frame, that the market is likely showing us a buying opportunity. Right now, there is a more clarity in this pair. Right now, the market is showing us a series of higher high, higher low, 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 higher high, which means that we will be looking for a buying opportunity in this pair. Are you getting me now? We'll be looking for buying opportunity in this particular pair. So what we need to do is that whenever we will be doing the market, we'll be looking for buying opportunity. But let's move a step further to the next time frame, which is the 4-hour time frame. But so in the 4-hour time frame, you still confirm that what I told you, or what I see in the weekly time, in the monthly time frame, the market is showing a sense of buying opportunity towards the upside. As you can see, it is showing us a sign of buying opportunity towards the upside. So we'll be looking for buying opportunity in the Euro GBP. I got me. Then let's head over to the to the 1-hour time frame. If you look toward the 1-hour time frame, you can see that the market is also somehow consolidate between these two spaces. Let's move to the 4-hour. The market somehow consolidates between the spaces. So this is the 1-hour time frame. As you can see now, the market is neither in the upside or in the downside, as you can see it right now. But somehow the overall movement is still showing us that the market is likely to buy. So what we need to do is that we will wait for the market to give us a clear signal for us to buy these assets. Understand? So we have to wait and step out of the market and wait for the market to give us a clear buy signal before we can enter this. So you can also move towards move toward the next time frame, which is the 30 minutes time frame, and that is where that I will stop when analyzing. So the 30 minutes is showing us that the market has been towards the downside, but also forming a strong bullish candlestick, showing us that the market is also likely to buy from this level. Are you getting me? But the most important thing in this Euro GBP is that it is showing a sense of buying opportunity. But if you don't have confidence in it, what you need to do is to step out of the market and wait for that currency pair to have a more clarity before you can now trade it. Are you getting it? So this analysis that I'm doing for you, can use it to analyze any pair, any asset, whether it is crypto, whether it is stock. It goes around any financial market asset. Are you getting my point right now? So let's head over to the next currency pair. The next currency pair will be Euro. Okay, sorry, it will be GBP JPY. Yes, of course, it will be GBP JPY. GBP JPY. Let's begin from the high time frame, as always, from the monthly time frame. As you can see, the GBP means Great British Pounds against the Japanese yen. So the market has been towards the uptrend. If you can see towards the monthly time frame, the market has been towards the uptrend. So it's very simple. Looking from left to right, the market has been a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So simply, the market is moving in a series of uptrend. So we'll be looking for buying opportunity in this type of pair. Are you getting my point? There is no need of us confusing ourselves. We'll be looking for buying opportunity in this type of pair. So let's head over to the next time frame, which is the weekly. As you can see it, this is a very clear, simple, and very clear, straightforward stuff. It is heading towards the upside. Series of higher high, higher low, 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 higher high. So it is a very clear, simple logic that the market is moving towards the upside. So we'll be looking for buying opportunity in GBP JPY. Then let's move forward towards the next time frame, which is the day time frame. As you can see, the day time frame, see the same thing. The market is moving towards a series of higher high, higher low, 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 higher high, showing us still same buying opportunity. We'll be buying this particular pair. Are you getting me? So once you are seeing this kind of things, there's no need of you paying for signal again. What you need to do is, once you are seeing this thing, you'll be able to wait for the right candlestick to form and gives you a clear signal for you to buy. Because the market is buying like this doesn't mean that you buy immediately. No, you wait for the candlestick formation to form. For example, in this uptrend, you wait for whether it is a bullish engulfing candle, or whether it is a morning, or whether it is a hammer. Once you see this opportunity, then you can buy from there. Are you getting my point? So don't waste your money trying to pay for signals, or trying to buy for, or trying to pay for someone else to give you signal. No, you can do these things yourself, analyze the market yourself, and also trade yourself. It will even give you confidence for you to trade the market. Are you getting me? Let's head over to the next time frame for more clarity, which is the 4-hour time frame. As we can see, this is the 4-hour time frame on GBP/JPY, the minor currency pairs. As you can see, it's still towards heading towards the upside. So we'll still be looking for buying opportunities. Are you getting me? So what I'm explaining in all these things is that I want to break everything down for you to see that the market moves in different conditions. Are you getting me? You can see that some currency pair, the market is moving towards the downside. In some currency pair, the market is moving towards the upside, and in some currency pair, the market is moving towards the ranging side. So the market have different phases. That is why I'm taking my time to explain everything for you to understand it, because I want to break everything down for you, so that you have to understand and grab everything from the beginning to the end. So now the 4-hour time frame of GBP/JPY is towards the upside. Now it's showing us a clear buy signal. Then we will go for 1-hour time frame, and what do we do? Look out for entry. Still in the 1 hour, the market is still moving towards the upside, right? The market is still moving towards the upside. What will you do right now? We will first of all wait for the market to retest down to this 2 point. Let me show you like this. So we wait for the market to retest down to 2.203.795. So if you're able to wait for the market to retest to this level, then it gives us a bullish engulfing pattern, or a morning star, or a inverse hammer, or a hammer. Then we buy from there. We continue to ride the wave of that uptrend. Are you getting me? Because the market has been in a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, and so on and so forth. So in GBP/JPY, in this kind of pair, in this kind of opportunity right now, you'll be looking for buying opportunity. Are you getting my point? So let's head over to the 30 minutes, which will be our last time frame. As you can see, the market has been in a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So we still be looking for a series for the market to move towards the low, maybe this level that I showed to you, this 203.964. If the market can be able to reach this level, then and forms a bullish engulfing pattern, or morning star, or hammer, then what I will do is that I will buy from here and continue to ride the wave of the uptrend. I getting my point? So it's short and simple. So there's no need of you complicating your chart with so many indicators. No, this is what we call a pure price action trading. Are you getting my point? No indicator, just a line and a pure chart. Are you getting me? You can see my chart is very simple and neat. There's no complication in my chart. There's no complication anywhere in my chart. You don't see any indicator. No, it's just a clear, plain eye and understanding of how the market move. Are you getting my point right now? So now let's head over to the next time frame, which is after the GBP/JPY. Let's head over to the next time frame, which is the euro. Yes, which is the euro AUD. The euro AUD. As you can see, the euro AUD, which is the monthly time frame. You can see the monthly time frame. The market is moving towards the upside. Are you getting my point right now? Yes, the market is moving towards the upside. Series of higher low, higher low, higher low, higher high. I getting my point now. As you can see it very well. As you can see it clearly. I getting my point. Then you move towards the weekly time frame. As you can see it, the market is still moving towards the upside. Series of higher low, higher low, higher low, higher low, higher low. As you can see it very clearly, the market is still moving towards the upside. So there's no need of you confusing yourself or complicating the chart. No, it is a clear understanding that this market is moving towards the upside. I got my point right now. So right now, let's head over to the daily time frame in Euro AUD. Mind you, the Euro AUD stands from the Euro currency against the Australian dollar. Now, in the daily time frame of this particular pair, the market has been somehow in the consolidation level. Are you getting me? Let me mark it for you. The market has been somehow in the consolidation level. The market has been in the it has been in support level from 1.72643 and also in the resistance level from 1.81600. So the market haven't able to break above or break below this support and resistance level, but still in the bigger time frame, which is the weekly and the monthly, it is showing us a buy opportunity. So generally you are still seeing a series of higher low, higher low, higher high, then forms a higher low, forms a higher high, and begin to forms a consolidation in this area. But let's believe that the market have the potential to break above this very level. What we need to do is for us to be patient and watch the market for it to react and unfold. Then when the market unfold its action, then we will react. Are you getting my point right now? So let me head over to the 4-hour time frame for more clarity. Understand? Then you can see in the 4-hour time frame, the market has been a series of lower low, lower high, lower low, lower high, lower low, lower high, lower low. But some points it started changing direction and now moving towards the upside. Higher low, higher low, higher low, higher low, higher low, higher low, and is now heading towards the upside, which is higher high. So right now, and this is a pure morning candlestick pattern. Yes, of course, this is a pure morning candlestick pattern in this kind of pair. What we do right now is that we enter a buying opportunity in this kind of pair and we buy from here, put our stop loss below this level, because we need to give a market a breathing space, and we can put our stop loss below this 1.7 below this 1.77166, so that the market can can play around and then move in a standard direction. I getting my point. Or if you have more, if you reduce more risk, you have to put it somewhere within this level, so that if the market breaks down, that yes, the market have invalidated a setup. But for more conservative trader, you need to put our stop loss somewhere here, somewhere in this under this week. I get my point, so that will be a safer away from the market structure. I get my point right now. So let's continue with the 1-hour time frame of the Euro AUD. As you can see, what happens? The market is moving towards the upside. Have you seen it now? Have you seen where I put my stop loss? But right, the market is moving towards the upside. So it still confirms what I'm teaching you, the overall directional movement, which is towards the upside, of what the bigger time frame, which is the monthly and weekly time frame, has been saying in this particular chart of Euro AUD. Are you getting my point right now? So let's head over to the final time frame, which is the 30 minutes time frame of Euro AUD. 30 minutes time frame of Euro AUD. As you can see, the market has been heading towards the upside in series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So peradventure that you have the trade to take, this thing is moving towards the upside, then you can buy from there. That is why I tell you to earlier before this video to go and download the MT4 or trading platform then register for demo account, and begin to analyze this pair. Check out these things for yourself. All these things that I have been teaching you, check it out one after the other. Once you check it out, try to practicalize everything that I'm teaching you, and you won't miss it, and you won't regret it. I getting my point, because this is the course. This is the only course that you will learn in the forex market. Everything concerning the forex market, you will be able to grab it one after the other. Now let's continue from where we stop. Let's head over to the next currency pair after the Euro AUD. After the Euro AUD, we have AUD JPY. It means the Australian dollar against Japanese yen. Are you getting me now? So the Australian dollar against Japanese yen, as you can see, the AUD JPY, the market has been moving towards the upside, towards the uptrend. Just take a look at it very, very well. Are you getting me? Just take a look at this market very, very well. The market has been moving towards the upside, a series of high, higher low, higher low. So the market have been moving towards the upside for a very long time, from 2020 up until 2025. Right now, the market has been moving towards the upside. So let's head over to the next time frame for us to confirm this our analysis, which is the weekly. As you can see, the weekly, the market has been moving almost the same towards the upside for a long period of time. Stress of higher high, higher low, 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 higher high. So it's still giving us a clear directional movement that the market is still buying. So we'll be looking for buying opportunities. Let's head over to the next time frame, which is the daily time frame. What are you seeing? Oh my goodness, just take a look at this chart. The market is still trending towards the upside. To confirm our analysis of the monthly and weekly, the daily time frame is telling us that the market is moving through the series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So in the general, the market is still moving towards the upside. Are you getting my point right now? So this thing is very, very easy and simple. That is why I'm taking my time to break everything down for you guys. Are you understanding? So if you haven't subscribed to the channel yet, subscribe to my YouTube channel, and also comment down below, ask me a question concerning any of this video. Are you getting my point? So look at this market right now, the AUD JPY. The daily time frame is still telling us that the market is buying. So it is still confirming what the weekly and the monthly time frame is selling, which is the uptrend. So we look for buying opportunities. So let's head over to the 1 hour time frame where we the 1 hour time frame where we stop. Okay, as you can see now, the network is disturbing. So the 4 hour market is where I will stop right now. Maybe I'll come back to it later. But look at it right now. The market is still showing us a series of higher low, higher low, high. So it's showing us a series of uptrend. So in this type of time frame, in this type of market pair or this type of currency pair, we'll be looking for buying opportunity at the moment. Are you getting my point? Look for buys. So, but the easy formula in this thing is this: when you see a buying opportunity, the market will be moving a series of higher high, higher low, higher high, higher low. But if it is a down trend, the market will be moving in a series of low, lower high, lower low, lower high, lower low, lower high, lower low. Are you getting my point right now? So let's continue from where we stop. Let's enter the next currency pair. Next currency pair after AUD JPY, we'll be moving towards the GBP Swiss francs. So let's head over to the network is stubborn in GBP Swiss francs. So let's head over to check out another time frame, another currency pair. After the GBP Swiss francs, we will be making use of NZD-JPY. So this is the NZD-JPY, the New Zealand dollar Japanese yen. What are you looking at this pair now? Towards the upside is the downtrend. Very simple. Series of higher high, higher low, higher high, higher low, higher high, higher low, higher high. It's very simple and straightforward. I'm getting my point right now. Uptrend. Then let's head over to the second one, which is the weekly time frame. Are you seeing it? The market is moving toward the upside again. Higher high, higher low, higher high, higher low, higher high, higher low. Are you seeing it? The market is moving towards the upside. Are Are you seeing it? So the market is moving towards the uptrend. Then let's move a bit towards the next time frame, which is daily. As you can see, the market is still moving towards the upside. A series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. As you can see, the market is still moving towards the upside. I seeing it. Then let's move ahead to the next time frame, which is the 4 hours. As you can see, the market is still showing us a clear buy signal, a series of higher high, higher low, higher high, higher low, higher high. So this type of we'll be looking at for a buying opportunity. So in this type of pair, you'll be looking out for a buying opportunity. I get my point right now. So let's finish it in the 1 hour. As you can see, the 1 hour is still showing us a clear sign of buying opportunity, that you can buy the market from series of higher high, higher low, 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 and no higher low. Let's continue. Are you getting my point right? So the market is moving towards the uptrend. So the NZD JPY, as I'm talking to you right now, is moving towards the upside. So we'll be looking for buying opportunity. Are you getting my point right now? So this is very simple, as easy as it is. So what you can use your naked eye, look the chart from left to right, and able to determine whether the market is either in the uptrend or in the downtrend or in the ranging market. But as of this market, it is in towards the upside or towards the uptrend or towards the buying opportunity. All of them are the same thing. Let's head over to the next currency pair. After the NZDJPY, we'll be looking for the euro NZD. Yes, of course, we'll be looking for euro NZD. The euro NZD. So the euro means that we are trading the euro against the New Zealand dollar. I'm getting my point right now. Let's begin from the monthly time frame. As you can see, the monthly time frame is almost that the market has been in a consolidation for a long period of time. So the market is neither up or down, but somehow the market is also showing a sign of buying opportunity in this level, in this 1.91452. As you can see it from that 1.91452 candle up to continuation, it is showing a sign of uptrend. But from this level down to this level, it's showing a kind of a consolidation. It is consolidating within the range of support and resistance. So in general, this market is consolidating in general, but it shows some sign of buying opportunity. Let's go head over to the next time frame for us to confirm this one. We move to the weekly time frame. Have you seen it? It is now showing us a more clear opportunity, which means that the market is buying. Have you seen it now? It is showing that the market is already buying. So we'll be looking for buying opportunity. I'm getting my point right now. So the euro NZD, the weekly time frame, is showing us a buying opportunity. So we'll be looking for buying setup. Where we can buy from there and move towards the upside. Then let's head over to the next time frame, which is the daily time frame of euro NZD. As you can see, the market is buying. Yes, of course. As you can see right now, the market is buying. So we'll be looking for buying opportunity in the euro NZD. I'm getting my point right now. So let's head over to the next time frame, which is the 4 hour time frame. As you can see, the market is moving towards the series of higher high, higher low, higher high, higher low, higher high, higher low, and higher high, which means that the market is moving towards the upside. We'll be looking for buying opportunity. I get my point right now. So if you're a day trader, you can stop at the 4 hour. But if you're a swing trader, you can stop at 4 hours. But if you're a day trader, you can move towards the 1 hour time frame and still analyze the same thing. Then if you're a scalper, you can move towards the 15 minutes or 10 minutes time frame and analyze and look out for buy setup or buying opportunity by checking out for maybe the morning star or the bullish engulfing pattern or hammer for your entry signal towards the bullish pattern, towards the upside. Are you getting me? So let's move towards the next currency pair. After the euro NZD, we'll be moving towards the Swiss francs, the Canadian dollar against the Swiss francs. So this is the Canadian dollar against the Swiss francs. Let's begin from the monthly time frame. As you can see, this market has been on a downtrend since 2009. The Canadian dollar has been on the downtrend against the Swiss francs. Series of lower low, lower high, lower low, lower high, lower low, lower low, lower high, lower low, lower high. So the market has been selling for a long period of time. As you can see it toward in the bottom from 2009 up to 2025, the market has been moving towards the downside. So what does it tell you? The overall direction movement of this pair is towards the downside. Let's confirm it by moving towards the next time frame, which is the weekly. As you can see it, the weekly still confirms the same thing, that the market is moving towards the upside. As you can see, the market has been moving towards the series of lower low, lower high, 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 lower low. So the market has been selling for a long period of time. We still give us confidence and conviction that the market is going towards the downside, that we should be looking for selling opportunity. Then let's check it out again toward the next candlestick, which is the daily time frame. As you can see, the daily time frame still confirms what I'm saying, that the market is moving towards the downside. So series of lower low, lower high, lower low, lower high, lower low, lower high. So meaning that you still look for selling opportunity. So there's no need for you buying in this kind of market, because everything is clear for you in your eye that the market is moving towards the upside. So what will you do? You will sell. It's as easy as that. Are you getting my point right now? So let's head over to the next time frame, which is the 4 hour, for us to confirm more what I'm saying. Look at the 4 hour time frame. The 4 hour time frame is giving us signal series of lower low, lower high, lower low, lower high, lower low. So we'll be looking out for selling opportunity in this kind of pair. Don't buy, no. Sell this kind of opportunity, because the overall directional movement, which is the monthly, weekly, the daily, is telling you to sell. So you look out for selling opportunity, then sell this market. I get my point right now. Then let's head over to the 1 hour time frame for our final confirmation. As you can see, take a look at it very well. The market is still moving towards a downtrend, and it is a clear direction that the market is still moving towards the downside. A series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. So the market is still moving towards the downside. So the market doesn't lie. So you need to open your eye very well to understand how to read this thing. That is why I take my time to break everything down for you one after the other. So right now, in the summary of this thing, this Canadian dollar against the chef, you will be looking for selling opportunity. What are the candlesticks that we'll be looking out for? We'll be looking for bearish reversal candlestick pattern, like bearish engulfing bar, the evening star, and inverse hammer. These are the candlestick patterns that we'll be looking out for when you want to sell this kind of pair. So let's head over to the next candlestick. Let's head over to the next currency pair. After the Canadian dollar Swiss francs, we'll be looking out for Canadian dollar JPY. Understand? So this is the Canadian dollar JPY. Let's begin from the higher time frame, which is the monthly. Like I always say, if you want to analyze the market, first of all, analyze the market starting from the higher time frame, then you move to the lower time frame. It is called top-down analysis. You analyze from the top to the down. So right now the market is almost, not just almost, is moving towards the up, is moving towards the upside, towards the uptrend. That means we are looking for buying opportunity. Series of higher high, higher low, high high, higher low, high high, higher low, high high. Let's move on towards the weekly time frame. As you can see, the weekly time frame, the market is still moving towards the buying opportunity. Series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. So we'll be looking for buying opportunity in this kind of pair. There's no need of you confusing yourself. So it is very, very clear. If you want to confirm this very well, you still need to go down to another time frame again, which is the daily time frame. If you move towards the daily time frame, you still find out that this market is moving towards the upside. Series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high. You look out for buying opportunity. I'm getting my point right now. So let's head over to another time frame, which is the 4 hour time frame. As you can see, the market is still moving towards the higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. It means that you are looking for buying opportunity. As simple as that. The same as if you move to 1 hour time frame, it's still showing us the same thing. The series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, meaning that we are looking for buying opportunity, that we should buy the Canadian dollar JPY in this kind of market condition. It is called the uptrend. So what are the candlestick pattern for these signals? It will be bullish engulfing pattern, it will be morning star, and also it will be hammer. Once you see them in the higher low, then you can take your trade towards the upside, which is the buying position. Put your stop loss and put your take profit. I'm getting my point right now. So let's move toward the next currency pair. So our next currency pair is Euro Swiss francs. Are you getting my point right now? So Euro Swiss francs. Let's move toward the monthly time frame. If we move toward the monthly time frame, as you can see, the market is in overall downtrend. That is very simple. Just take a look at the chart from left to right. The market is in overall downtrend. No twos about it. We are looking for what? Selling opportunity. After that, move towards the weekly time frame. The market is in overall downtrend in the weekly time frame. Are you seeing it? The market is in overall downtrend. Series of lower low, lower high, lower low, lower high, lower low, lower high, lower low. So we are looking for selling opportunity. Then let's move towards the daily time frame. Once you can see, as you can see, the market is still in the downtrend. So we are looking for what? Selling opportunity. As simple as that. Let's move towards the 4-hour time frame. See, towards the 4-hour time frame, the market has been series of lower low, lower high, lower low, lower high. Then once it begins to form a new lower low, you will sell from here. Which candlestick pattern are we looking for? Bearish engulfing pattern, evening star, and inverse hammer. Very simple, a clear selling opportunity. But if you're a day trader, you can move step further, whether in 1 hour time frame or in 15 minutes time frame, and find out for a different entry for you to enter the sell signal. Are you getting my point right now? So let's head over to another candlestick, which is the Euro Canadian dollar. The Euro Canadian dollar, as you can see, the market has been moving in a series of lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. So what are we looking this pair? I'll be looking for selling opportunity. So but right now, let me move to the monthly time frame for me to clarify everything for you. So as you can see now, the market has been ranging somewhere like this, but later on the market begin to move towards the upside. So moreover, right now I'm looking for more of buying opportunity than selling opportunity. So that's a mistake. I forgot to click on the monthly time frame to analyze. So that is why you need to be very careful when trading. I get my point, to avoid making mistakes. Understand? Because a little mistake can cost a whole lot your trading account if you're not very careful. I get my point right now. So right now it is a buying opportunity in this market, but let's confirm it in the next time frame, which is the weekly. As you can see, overall directional movement of this thing is buying opportunity. It is moving toward the uptrend, a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high. We'll be looking for buying opportunity. Let's head over to the daily time frame. As you can see, it can confirm that the market is still moving in a series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. So we are looking for buying opportunity. We'll be looking for buy in this kind of pair. Then let's head over again the next time frame, which is the 4 hours. The market has been in a downtrend, series of lower low, lower high, lower low, lower high, lower low, lower high, lower low. So but we form a, we wait for the candle to give us a new sign in this low, as it's showing us a buy signal that you can buy from here. I get my point. And what are we buying? We are buying with when we see the bullish engulfing pattern, or when we see the morning star, or when we see the hammer, we buy from there. So let's continue and move ahead next to the next currency pair, which is the Chef JPY. Once you see the Chef JPY, let's begin with the monthly time frame. Like I always say to you, if you want to analyze the market, start from the monthly time frame, then you move down to the smaller time frame. As you can see now, the overall directional movement of this pair on the monthly time frame is towards the upside, towards the buying opportunity. Then after the buying opportunity, what will you do? Move towards the next time frame, which is weekly. What do you see? The market is still moving toward the upside, series of higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Are you getting me now? So it's a very simple. Then now let's head over to the next time frame to confirm these things with that I'm teaching you. Then we are on the daily time frame. The market is still moving towards the upside. See the series of higher high, higher low, higher high, higher low, higher high, higher low, higher high. So what are you looking for this opportunity? You are looking for buying opportunity. So don't trade against the market. Follow the trend. The trend says buy, then buy. If the trend says sell. But if the say is to show you that the market is not going anywhere, stay out of the market to avoid confusion. It's very simple. So right now the market is moving towards the upside on the day time frame. Let's head over to the 4-hour time frame for us to confirm more and more. Can you see it? The 4-hour time frame is still showing us the buy opportunity for us to buy series of higher high, higher low, higher high, higher low, high high, higher low. What does it mean? Look out for buying opportunity. Then if we move towards the 1-hour time frame where I will stop, still the same thing. It's still showing you a buying opportunity. Series of higher high, higher low, higher high, higher low, higher high, higher low. So in this opportunity, what we'll be looking out for is that we'll be looking out for bullish reversal candlestick pattern. What are the bullish candlestick pattern? Which are the I've already explained before. The bullish, which are the morning, the hammer, and the bullish engulfing pattern. Are you getting my point right now? So let's head over to the next currency pair, which is after the chef JPY, which is the final one, which is the XAUUSD. Normally XAUUSD is good. This thing is not currency pair though, but it is a commodity. Gold, it is a commodity. It is being traded in the forex market, so it is a commodity. So this gold, you also analyze it the way you analyze other currency pairs. There is no difference. So you analyze gold the way you analyze your normal currency pairs. That is why I put it in this chart. So as you can see, the overall movement of this gold right now, the overall movement of this gold is towards the upside. As you can see, this market has been towards the upside as far back of 2004 up until 2005, up until 2025. The market is still moving towards the upside. So the overall directional movement of this gold has been towards the uptrend. But are we buying? No, we are not buying right now. Rather, I will move towards the next time frame, which is the 1-hour time frame. Take a look at this right now. The 1-hour time, not the 1 hour, the weekly time frame. I mean, so as you look at the weekly time frame, the market is still showing you signs towards the upside on the weekly time frame on gold, meaning that we are looking for buying opportunities. Then what do? We'll move to the next time frame, which is daily time frame. As you can see, the daily time frame is still showing us a signs which is moving clearly towards the upside. That means we'll be looking for buying opportunity. So what are the buying opportunities in this thing? When we see a bullish engulfing pattern, when we see a hammer, and when we see a morning star candle, we will buy. Then let's head over to the 4 hours for us to confirm more. As you can see, the market is still showing us a clear sign that after the correction phase, the market moved towards the upside and is now correcting and is about to move another towards the upside, still showing that the overall directional movement always win, which is the upside in this pair currently, which is the XAUUSD. Then if you move towards the 1 hour time frame, then the market is showing you that the market have already come down, have already been a series of lower low, lower high, lower low, lower high, lower low. But now we have to wait for this to give us a clear signal, a clear direction that is going towards the upside. Then we buy from there. Once it gives us a candlestick pattern like bullish engulfing, morning star, or the hammer, then we buy. We set our stop loss and we set our take profit. So what I want you to do in this episode 5 is that go ahead to your Play Store. If you are using an Android or if you're using an iPhone, go to your Apple Store, download the MT4 or MT5, open a demo account, begin to analyze every single thing that I have already explained to you in this currency pair. I got in me. So that you can be able to grasp and understand everything on how to analyze the market, because I have been able to break everything down for you, how to analyze the major currency, the minor currency, and also this is how you also analyze it if you want to trade exotic currency. It is the same formula, the same format. Are you getting me? So go ahead to your Google Play Store or iOS Store, download this MT4 or MT5, begin to master and begin to practice everything that I have already taught you. Are you getting my point? So that you won't miss out in every of my lessons. So right now, let's head over to episode 6. Are you getting my point? So let's head over to the next episode, which is episode 6, and I will see you right after the next episode. So let's head over to episode 6. Thank you.